Before we start this video, do like and subscribe to our channel and not miss on any updates.
Hello dear friends, welcome to the revision session on M&A and corporate restructuring chapter. This is the last chapter before your startup in ICA study material. It's a very important chapter. Questions have been asked from this chapter quite a few times. Students sometimes do make mistakes, they make logical and conceptual mistakes. So in this revision session, my attempt will be, of course, to solve a bunch of problems which are fairly important, but also try and clear some basic concepts or give you some tips and tricks, right, which will help you succeed in your exams. But before we actually get into this, please like, share this video. Please refer us to your friends and also, of course, do subscribe to our channel. It will help us reach a wider audience. So if you've done liking and sharing, then let us dive into the topic. Most of you know me. I'm co-founder and CEO of IndigoLearn. I, Suraj, and a bunch of faculty, all of us run it together. And I'm faculty for CFA and AFM as well as CFA. I've taught 4,000 plus students. I'm very, very interested in financial markets and economics. Right. So this M&A chapter is also fairly close to my heart because I've done live M&A deals, 2 big deals. I've done bunch of fundraising stuff with respect to startups as well as my own entity. So this is again a chapter that is fairly close to my heart. So let us first start look at a few theoretical concepts before we jump into how to solve problems. Basic theory, nothing very, very fancy. Let us see. What is an acquisition? Acquisition is one where one player buys out other to combine with itself. Acquire. So somebody is acquiring other. By a purchase or by a management buyout. So it is either by way of purchase of a business where you buy, you buy the entire business from shareholders. I am A, I am acquiring a company called B. I will buy out entire shares of B from B shareholders. Or management buyout where the management buys out business from its owner. That is, I buy out the business from the owners. That is, the shareholders will sell their business to me. They will continue to remain the shareholders of the company. Okay, that is one way. What is amalgamation? Amalgamation is absorption and blending of one by the other or 2 or more companies joining to form a new company. So, amalgamation is 2 entities, one entity is acquired by the other and fully merges into it, fully gets amalgamated into it, or both entities together form a new third entity. Right. What is demerger? Demerger is a form of corporate restructuring in which entities' business operations are segregated into 1 or more components. Merger means coming together. Demerger means splitting. That is, a company is splitting one division or demerging a division, demerging a business from itself, and it is putting it out separately. It is selling it, listing it, whatever it is. What is a cross-border merger? It is a merger of 2 companies that are in different countries. Indian company merging with a foreign company or vice versa. Cross-border M&A, basically, Tatas have done a lot of that. They acquired Jaguar Land Rover. So, Tata Motors acquired Jaguar Land Rover, right? So, things like that, where an Indian company acquires a foreign company or a foreign company acquires an Indian company. Now, what is the rationale for M&A? Why do people do M&A? One of the biggest rationales is synergy. This term called synergy. What do you mean by this term synergy? Synergy basically means the value of 2 independent parts, okay, is, if there is a business, let's take of Infosys and Wipro. Infosys plus Wipro, Infosys value is probably, let's say, 2 lakh crores. Wipro value, let's say, is 1.5 lakh crores. Both put together, and I say value, I'm thinking of market cap. So 2 lakh plus 1.5 lakh is 3.5 lakh. But when you combine those 2 businesses, there is a potential for a lot of synergy. Synergy means you probably get better business, you probably cut costs. There is a lot, the combined P&L and balance sheet probably will look very different than simple addition of numbers. You'll have a lot of management, a lot of unnecessary management is taken away and all of that. So that way there is a lot of synergy that can be gained. Now because of that, it is not 3.5 lakh crores. What did I say? 2 lakh plus 1.5 lakh. This is Infi, this is Wipro. The value of these 2 probably will be 4 lakh crores, not 3.5 lakh crores. That is what we are trying to convey. Right. So this happens because of, as I said, efficiency improvement. First one is efficiency improvement. That is, there is a lot of efficiency. You don't need multiple managers, you don't need multiple offices, probably economies of scale. You can probably get things at better prices. You can probably get real estate at a better price. You can probably have a bigger facility where cost per square foot is lower, so on and so forth. And it probably helps you in diversification also. So Infosys may be very good in BFSI. Wipro may be very good in industrial. BFSI means banking, financial services. Industrial means industries, basically manufacturing industry. So both of them complement each other very well. Right. There may be taxation benefits. One of them may have some tax losses. The other can set them off. then there is a possibility of growth. Because you are working together, there is much more possibility that you are a big entity and you may get much bigger government contracts or much bigger private sector contracts, or you may be able to deploy more money in growth opportunities. You may have greater risk capital, so you will deploy money in risky ventures that may give outsized returns. Right, you will have greater managerial talent pool. You have a lot of people from whom you can hire, from whom you can promote, who can lead, and all of that. Same way, it will also help in consolidation. That is, when the market is too fragmented, then people come together. There is a benefit that accrues to the players who have merged together. Industry also benefits, and the two players who have come together or merged or amalgamated, they also benefit. So this is broadly the rationale for M&A. Now, what are the objectives for amalgamation? See, you have something called as horizontal growth, that is to achieve size, market share, curb competition, use unutilized capacity. What I told you, Wipro and Infosys. Okay, extreme example. Then you have something called as vertical. Horizontal means they both are on the same plane. Wipro is also doing same business, Infosys also is doing same business. But think of vertical combination. What is a vertical combination? Vertical combination, the best example of vertical combination is, let's say Zomato. Zomato acquiring a huge restaurant chain. Think of one restaurant chain. Think of somebody like Paradise Biryani, or think of somebody like your Domino's, right? So what happens? Zomato doesn't have its own kitchen. It is just an aggregator. But when it has its own kitchen, they both are in different verticals. That is, Zomato is in delivery space, your Pizza Hut or Domino's or any restaurant chain, or even Haldiram's for that matter. They are all in food particular vertical. When you combine these two verticals, Zomato probably may be able to deliver these products much better. Right? So both the people get advantages. So both the people can take advantage of it. So it economizes costs and eliminates taxes. It helps in diversification. Obviously, when you have different people, as I explained earlier, when there is possibility of two different people coming together, portfolio gets diversified. What happens in diversification? If one business is in loss, another business may be in profit. This may bring up the overall, on an overall basis, the company will be able to face any kind of circumstance or situation. Then utilize idle funds lying with one company for other companies' expansion. Absolutely. Think of something like, same Zomato and Pizza Hut example. Pizza Hut may have a lot of cash. Zomato may use that cash to grow further, right? So things like that can happen. Merger of export, investment in trading company with industrial company, or vice versa to increase cash flow. So what happens in these trading companies? Trading companies keep buying and selling every day. So there is a lot of flow, but profit margins are very thin. Whereas if you look at export companies, companies that sell goods abroad, they have good margins, but cash flow is not there. So when you combine multiple businesses into a conglomerate, there is a benefit in terms of cash flow management. You are able to manage the cash flow better. Then same way, subsidiary and holding can also merge in order to improve the cash flow of one of the business. Or you can take over a shell company with license or nourishing a sick unit in the group. So a lot of people do this also. If let's say there's a sick unit which has a lot of unclaimed taxes, they take it over. Or if that sick unit has a lot of licenses, you take over and then you use the licenses. Or there is a sick company in the group. Think of Tata Group, Birla Group, Murugappa Group, some group. There is a sick company. So you take another firm, buys out, or merges that sick company with itself. So the overall group image is maintained. So you have things like that, varieties of reasons why people do amalgamations. Now, are all of them rational? Maybe, may not be. But definitely, these are largely the reasons why people do amalgamation. Now, what are the types of merger? We just explained this horizontal. Basically, your Infosys, Wipro, which is horizontal merger, is of merger of competitors. Then vertical, buyers and sellers. I gave you an example of Zomato and food chain like Domino's or Pizza Hut. Conglomerate, unrelated. Think of L&T buying out Paytm. How are they both related? They don't have. There is L&T Finance, but L&T is not a digital first entity. Paytm is a proper digital business. If you think of merging those two, it's a completely unrelated business. Okay, or let's take some biscuit manufacturing company, buys out steel manufacturing company. Is there any relation between them? No. Right? Things like that. Then you have something called as congeneric. What is congeneric? Related industry but different products. So think of, there's a business, somebody manufactures your power transformers. Okay, electricity transformers. We see transformers, right, near our houses, in junctions and all. Think of a company that manufactures power transformers and they buy a switch manufacturing company. Both are in same industry, power equipment related, but one is transformer, one is switch. Okay, very some level similar, some level different. Or reverse merger. What is reverse merger? Reverse merger is small company acquiring big, usually a shell company acquiring a public limited company. So what happens is, a lot of times small companies which are listed, which are shell, okay, they don't have any business, they're just listed. If I run a business and I want to list my business, I have to go through this IPO process, go and file a DRHP with SEBI. DRHP means draft red herring prospectus. You would have learned that in law. So all that activities I have to do. Instead of doing that, if I were to merge my company with the small company which is listed, or a shell company or something that is already listed, it is an easy way for me to list my shares without going through all the jamela of trying to, jamela means all the nuisance and nonsense of trying to file with SEBI, get clearances, appoint investment banker, pay them, all of that can be avoided directly buying a shell company. Then we can also do acquisition for acquiring control interest. You don't fully amalgamate with you, but you acquire controlling interest so that you can direct their operations. So these are various types of mergers. Now, what are the gains from synergy? We were just discussing why this whole thing of V plus A plus V of A plus value of A plus value of B is greater than value of AB, which is you have the value of acquirer and you have the value of the target. Both of them, when you combine, you also get an additional value called synergy value, which is what I was telling you. Okay, but there is a small subtraction cost, transaction cost. This transaction cost has to be eliminated from the synergy. That is when you get this combined value. So the combined value is more than sum of individual values, but is less than individual values plus synergy because there is a cost element attached to it. This is something that you should remember. Now, as far as amalgamation is concerned, there are three things that you should know. One is called scheme of amalgamation. Basically, it's a document that outlines how are the assets going to be transferred, who's going to do what, how many shares are going to be issued, what is the swap ratio, when will you do that, what are the creditors going to do, all of that. Then you have something called as appointed date, the date on which it takes place. The date on which there is a date on which everything takes place. You say from this date onwards, this old company ceases to exist and everything is a new company. Then effective date on which merger is completed and merged companies are dissolved by ROC. So the new company is now only company and the new company is the only company that is existing. The old company is dissolved by ROC. That is known as effective date. So appointed date and effective date. Please remember these two. Then, what are the factors that are considered in financial evaluation of an M&A deal? One, what is the maximum price of the target? So, if I am acquiring a company, let's say I am A and I want to acquire B. B's market cap. What is market cap? We'll discuss that. B's value the value of its shares is 100 CR. Am I willing to pay entire 100 CR? Do I want to pay 120? Do I want to pay 130? For full stake, by the way. Right. So, that is what is the maximum price A wants to pay for B. What are the principal areas of risk? Okay, I will acquire B, but then will B give me that value? Are there skeletons in the cupboard of B? Skeletons in the cupboard means, are there any contingent losses that I am not aware of? Are there any major disputes that I am not aware of? Is B's business viable? After I take it over, will it shut down tomorrow? So those are all the risks. What are the cash flow and balance sheet implications of the acquisition? If I acquire this company, what will happen to my balance sheet? That company has huge debt, so that debt will become my debt. Because of that, my overall debt equity ratio will go for a toss. Because of that, my credit rating will go for a toss. Because of this, my cost of borrowings will go for a toss. Okay, what is going to happen to my balance sheet? And when I have to repay all those debt, my cash flow is going to take a hit. Is it, even then I want to acquire it, is it still worth it? All those factors also have to be evaluated. What is the best way of structuring the acquisition? How do I structure this? That is, do I acquire fully? Is it by share issuance? Is it by issuance of, is it by paying cash, or is it a mix of share and cash? Or, I don't acquire 100%, I acquire only 51%, I acquire at what price? All of these come into play. Valuation, of course, differs on case to case basis. What I want to acquire at, today may be different from what I want to acquire at tomorrow. What are the things I will consider for valuation? It is purely dependent on negotiation between buyer and seller. We discussed this in business valuation chapter also. How to pay, that is cash, stock, mix. This also we discussed. Right. Now, What is the takeover process? Takeover can happen on friendly basis or hostile basis. Friendly means I come to you and say, hey, hi, I want to take over your company, and you say, yeah, very good, let us work together. You give me my 100 crores, I will give the company and walk away. That is friendly. What is hostile? I come to you and ask for your company, and you say, get lost. I don't want to sell to you. I will fight. I will, my shares are listed, your shares are listed. Let us see what we will do with these shares. If you are going to make an open offer, you would have read about an open offer process in law. If you make an open offer, I will also make a counter open offer. Or I will talk to my shareholders. I will convince my shareholders not to do something. So like that, you will do a variety of things, right? That is called hostile. So friendly, where your target board agrees for acquisition. Hostile, target board disagrees and acquirer is forced to make an open offer. Acquirer is forced to make an open offer. Now, in hostile takeover, what are the strategies? We'll look about strategies in hostile. See, in friendly takeover, there is nothing. No, you both agree on something, you pay the money and then get out. But in hostile, there are quite a few issues. What are the issues? Something called as street sweep. What is a street sweep? Acquirer picks up large stake in the target before making an open offer. Now, in India, if you cross the threshold of 15%, you're bound to make an open offer. So, you slowly acquire 1%, 2%, 3%, 5%, and slowly you and persons acting in concert, that is what is the technical term, right, as per SEBI, you acquire 14.9% stake. And then suddenly one day you convert that 14.9, you acquire some small shares, cross 15, make an open offer. You do things like that. That is called street sweep. That is, you are sweeping all the shares that are available in the street. Street means Dalal Street or Wall Street. Bear hug. A bear hug is acquirer threatens open offer and target agrees for a settlement. So I come and tell you, I am going to make an open offer. Then target says, no, why you want to do open offer, this whole process? Okay, chalo, we will settle this out of courts. Either you acquire me fully or let us agree that, you will not acquire, and let us agree for an out-of-court settlement. I will make some changes, you'll get a board seat, you can also give your views, things like that. Then strategic alliance. I want to acquire your company. I will start saying, let us be friends. Let us, I want to take 5% stake in your company. I want to be your reseller. I want to, distribute your products. Let us get into some other joint venture. Like that, I will want to have some kind of connection, alliance with you, and slowly as the trust builds and as I understand your business well, then I will decide on how to make an acquisition. This is called strategic alliance. Then you have brand power. Ally with powerful brands to displace competing brands. So if I want to acquire you, so let's think of HUL. HUL, let's say, is planning to acquire some other company. So, and not in its own business, slightly different business. Let's take some chocolates. HUL is not in chocolates. So what they do, who are there in chocolates? Your Cadbury's, Nestle, Amul, these are bigger players in chocolates. Let's say there is a small company called XYZ. This is small. Then there is a big company called PQR. And then of course there are Nestle, Amul, Cadbury's and all that. All these are international players, big players, you can't do anything. So what HUL will do is, HUL will say, if I want to acquire XYZ, I will not directly interact. I will go and talk to slightly bigger player called PQR, and I will ally with them. I will make some positioning with them. I will say, I will distribute your products. So that way XYZ will get threatened, and XYZ will say, okay, come now, please acquire me. Okay, you basically ally with powerful brands to displace competing brands. So I will ally myself with powerful brand to displace other brands whom I want to basically acquire. So these are the ways in which actually takeovers happen, friendly as well as hostile. Now let us come to practical questions tips. I've given you a brief idea of the theoretical aspects. Now let us jump right into the practical aspects. So when you look at this particular chapter, right, a lot of students get confused between this whole thing called swap ratio or exchange ratio. How is it arrived at? So I'll give you an easy way. We'll spend some time on these logics, okay? I want to explain these logics before I jump into the problems, because these logics are very important. Let's say EPS is in rupees of acquirer is 30 and target is 20. And the swap ratio is determined on ratio of EPS. That is 3:2. Swap ratio is determined on the basis of this 3:2. So what does it mean? Does it mean, see, acquirer has EPS of 30, target has EPS of 20. Acquirer is stronger because they have EPS of 30. Target is shorter, not so strong, they have EPS 20. So the small fellow or the weaker fellow has to give more shares to get some fewer shares of acquirer. That is, if I am small, I have to surrender more, get less. If I am big, I will surrender less, get more. right? Big, small or stronger, weaker is purely in reference of this EPS. Can this be in terms of price? It can be in terms of price. They will give that to you in the question. So the swap ratio is ulta. What do we mean by ulta? Ulta here means for 2 shares of acquirer, you will get 3 shares of target. That is, in the target, if somebody holds 3 shares, they will get 2 shares of acquirer. Or the acquirer will give 2 shares and get 3 shares in return. Because I am stronger, I am smarter, so I will give lesser shares of 2 and I will take more shares of 3. Why is this 2:3? Because of this ratio of 30:20. That is, it is a simple logic. Whatever is the ratio of the EPS, the swap ratio is ulta. And when I say ulta, it basically means reverse, opposite, right? The swap ratio is going to be 2 shares of the stronger person going away and 3 shares of the weaker person coming in, or 3 shares of the weaker person going away and 2 shares of the stronger person coming into the weaker person. So this is the logic. If you remember this logic, right, half the problems will be solved. So swap ratio is 2 shares of acquirer exchange for 3 shares of target. Okay, this is something you should remember. Now, I want to explain certain terms for you. Market capitalization. We have discussed this in the business valuation chapter also. I want to just repeat it in case you have don't remember it, because a lot of CS students forget. Market capitalization or MCAP, people call it as MCAP or market cap, in rupees, is market price per share in rupees, whatever is the share price, into total share count. That is all shares issued, paid up, subscribed shares. Okay, if they are partly paid up and all, you will take equivalent. Okay, and this is equity shares only, but it does not consider shares that are authorized capital, unissued capital and all that. No, issued, subscribed and paid up, and it considers equity only. So all shares, whether the shares are held by promoters, whether the shares are held by retail, FII, DI, all that don't matter. And you may have differential voting right shares also. You add those also. Okay, so that is market cap, right? And if you have any converts, those are also taken into account. Then promoter holding. What is promoter holding? Total shares held by the promoter divided by the share count of the company. Total shares held by the promoter by the total share count of the company. Promoters typically hold 20%, 30%, 40%, 50%, up to 75%. Why? In India, if you hold more than 75%, you cannot list. Okay, I am referring to market cap. Market cap is what context? Is listed shares. Okay, other than government entities, private, non-governmental entities, necessarily, the non-promoter holding should be more than 25.01%. Correct? Then what is free float? Free float is ulta of promoter holding. That is, how much is free for the public. That is 1 minus promoter holding, or 100% minus promoter holding is basically your free float. So free float market cap is what? Basically this free float market cap is whatever is your free float percentage multiplied by total market cap. So Infosys, let us say, is 2 lakh crores value market cap. Mr. Narayan Murthy and Ms. Sudha Murthy, Mr. Nandan Nilekani, Mr. Krish Gopalakrishnan, like that 7-8 people are there who are promoters. They hold together 10%. So promoter holding is 10%. So non-promoter or free float is how much? 90%. What is free float market cap? 90% into 2 lakh crores, which is 1.8 lakh crores. This is free float market cap. That is how you have to see. Right, you are going to be asked in questions, they've asked such kind of topic, such kind of stuff. That is why I'm explaining. Then, what are the exchange ratios typically used for valuing companies? So, you value 2 companies in an M&A deal and say this company is valued X, the other company is valued Y. Now, let us figure out the exchange ratio. Same logic here. I said no, 30:20 or 3:2. Exchange ratio is 2:3. Ulta, right? So I gave you example of EPS. You can use EPS, you can use market price if both companies are listed, you can use intrinsic values, do some kind of DCF, do some kind of comparable company, do any kind of magic mix masala, okay, and arrive at an intrinsic value, or do even book value. You use any of these ratios or a combination of all these ratios also, okay. You can value 2 companies, let's say Infosys and Wipro. Infosys, let's say share price is 2000, Wipro share price is 1000. So the ratio of prices is 2:1, so swap ratio is 1:2. So for every 1 share of Infosys, Wipro people will have to give back 2. Now this is one logic. This is what? Market price. Then you may have EPS. EPS may be 150, 80. That may be different. Book value may be 1500 and 950. That may be a different ratio. Or you do a DCF, VCF some other way and you find this is 2200, this is 1700. You may do that also. Or you can do a weighted average of these also. Okay. This normally market price, EPS, book value, EPS people don't do. By the way, that is only in our ICA study material they have given. So, which is why I am telling you, nobody does EPS based merger swap ratios. People do market price, intrinsic value or book value. Okay. Or net asset value, things like that. Whatever we have discussed in business valuation chapter. If they are giving weights, how do you do this? How do you solve for ideal exchange ratio if they give weights? I want to explain that to you. So, how do you use weighted average price under various scenarios? I will explain this only the concept. When we go to the problem, we will discuss this in greater depth. So, let us say EPS is 3 of the acquirer, 2 of the target. So, the ratio is 3:2, but ratio is 3:2. So, what is the, if you convert it into decimal, it is 1.5. If let us say this has a weight of 30%, you directly multiply this 30% into 1.5 and derive at 0.45. Same way, let us say book value is 8:5. So, you multiply, you first find out 8 by 5 which is 1.6, 1.6 into 10% is 0.16. Same way 7:5, you do 7 by 5 which is 1.4, 1.4 into 20% is 0.28. Then 2:1 which is 2 by 1 is 2, 40% into 2 is 0.8. So, you have different weights which add up to 100. You multiply the respective weights with the decimal value of the swap ratio and arrive at a combined ratio, arrive at a weighted average ratio. What is this weighted average ratio? Weighted average ratio is summation of all of this, 1.69. What does this 1.69 mean? See, if you look at this, acquirer is stronger, target is weaker. Acquirer EPS is 3, target EPS is 2. Acquirer book value is 8, target book value is 5. So, acquirer is stronger. So, the ratio is 1.6:1. What do you mean by 1.6:1? 1.6:1 is the value of share of acquirer is 1.69, the value of the share of target is 1. So, 1.69:1. This means shares of acquirer are more valuable. So, swap ratio is 1.69 shares of target are required for every share of the acquirer. So, 1.69 shares of the target have to be given in order to get 1 share of the acquirer. Right. So, you do this weighted average basis. If you get doubts, please listen to this again. Okay. It is a very simple computation. I am not doing anything fancy. I have just taken this ratio 3 by 2, 1.5, 8 by 5, 1.6 like that. Taken them into, converted them into decimal, multiply that decimal into weight, get an overall value, get the weighted average, sum of all of that, and that 1.69 whatever I have got, I am now trying to tell you how many shares of acquirer should be exchanged for how many shares of target. And whoever is stronger, they will give lesser shares and they will get more shares. So, they will give 1 share and they will get 1.69 shares of the target. Okay. Now, when the question says swap ratio is 1:2, there have been times when institute is asked what is swap or the exchange ratio between the two companies is 1:2. Without detailing who is acquirer or target. Okay. They have done this few times. When such kind of things happen, the best way to handle is please look at it. Who is stronger on an EPS basis, book value basis, market price basis, intrinsic value, whatever data is given, please see which one of them is stronger. So, the stronger person will give out less shares. So, in this case, if it is 1:2, right, the stronger person, and they say swap ratio, they are not saying ratio of EPS or ratio of prices or ratio of values. This is swap ratio. Swap ratio means directly, without making it, swap ratio means directly, that is directly after doing this ulta business. I said ulta, no, here. After doing that ulta, the swap ratio is 1:2. That is for 1 share of acquirer for 2 shares of target. That is what it means. Okay. This is one way. Usually, they have avoided asking questions, but there are questions in the material where they have asked like this. Then, in some questions, they sometimes give, this company will give a bonus, then they will split the shares and then they will do the merger. What do you mean by that? First, bonus shares are issued, then the bonus shares are split. Bonus first, split next. Okay. Especially if they don't specify the order. The next step is where question states that exchange ratio should be on no loss basis to shareholders. That is, when shares are being exchanged, the swap ratio should be arrived at it such that shareholders don't lose out. Now, don't lose out on what? Do they know don't lose out on value or do they don't lose out on EPS? So, as far as real world market is concerned, it is usually value. ICI in some questions has interpreted it as to mean that none of the shareholders lose out on EPS. Okay. Now, which one is right? From a real world perspective, value is right. From ICI's perspective, they will usually specify that shareholders should not lose out on EPS basis or market price basis or something like that. If they don't specify, if they specify, follow what they specify. If they don't specify, compute it under both the methods. If the question is not specific, solve using both EPS ratio as well as current market price ratio. Okay, this is my suggestion. Okay, because there were some older questions or questions that are very fairly old, I think 7-8 years ago, where they probably meant that they want EPS, but they didn't mention exactly that they wanted the swap ratio to be in EPS. They just said, neither party should lose out. And they interpreted it as if, neither party should lose out on EPS basis. But that really doesn't work that way in real world. So my suggestion, use both EPS ratio and market price ratio to arrive at differing swap ratios and compute everything under both the methods. Then, quite a few times when we look at this merger, right, what is the valuation of the combined entity? Let us take two entities. One is acquirer, one is target. Market cap of A plus market cap of B plus synergy value. That is how you normally look at it. Okay, that is how you normally look at it. Then, can we say in certain cases, because you are going to see some problems where the acquirer has a higher PE, the target has a lower PE. Okay, if you're not understanding this element, wait for a few questions, you'll understand this, but just try to follow what I'm saying. If the acquirer has a higher PE and target has a lower PE, post-merger, is it just combination of these two market caps, or will the new firm's EPS, new firm's profits, or rather the merging target firm's profits get merged with the acquirer firm's profits, and on the entire profit, old PE of the acquirer is applicable, or a completely new PE ratio is evolved? How does it work? So typically take it as just simply addition of market caps. Unless they specify that the new entity, merged entity, also has same PE as the acquirer, don't follow it. So use acquirer PE for valuation of merged entity only if specified. Okay, in a real world perspective also, it doesn't mean that automatically the old firm PE will continue. The PE, there may be an adjustment. So analysts sitting there are not jokers, no? They also know, if you and I can know this, the analysts will also know. So in a real world perspective, it is not clearly defined. It may be just sum of market cap plus synergy, same old firm PE may continue, anything can happen. Okay, PE may come down, right? Then what is true cost of merger? So now this is one question that I actually don't like the way I say ask. They say, what is the true cost of merger? What do you mean cost of merger? So, and see, if you look at it, what is the cost of merger? Cost is not the expenses that you incur. They are not referring to the expenditure that you have incurred on the merger. They are saying, have you given away more than what you ideally should give out? So let's say you are acquiring a company for 100 crores. Its value is only 80. Okay. Synergy benefit 1 or 2 something, let's take synergy benefit is 5. Value is 80, synergy is 5, you've acquired it for 100. So there the true cost of merger is this extra 15 crores that you have paid. Right. Is that what that they are saying? On face of it, that is what it appears. But let us see. Post-merger market cap of target and pre-merger market cap of target. But after merger happens, how will the target have market cap? No. What they mean here is the share of the overall market cap that pertains to the shareholders of the target. So, let's say acquirer, target. Acquirer had a market cap of 100, target had a market cap of 10. When they both merged, let's say these 10%, these people eventually got a 15% stake. Now the merged entity, whatever is the swap ratio, based on that they got 15% stake. Now the merged entity has a market cap of 120. In this 120, what is 15%? 15% of 120 is 18 crores. Okay. Now the value of this business when you acquire is 10. Probably some synergy benefit 1 or 2, 11. But you have paid 18, or rather what they have got in terms of market cap is 18. So the cost of merger is difference between these two, that is the 7 lakhs. Okay, that is what they are saying. So true cost of, and I ideally don't like this logic, very weird logic. But anyway, post-merger market cap applicable to the target, or the post-merger market cap of the shareholding of the target in the acquirer minus pre-merger market cap. Okay, another way to look at it is, what is gain from merger? Gain from merger. Gain from anything. Let's say you buy a house, okay, or you buy something and sell something, buy a house and sell the house. How do you compute gain? what sale price minus purchase price. So here also gain from any M&A deal is what is value received minus price paid. Value received minus price paid. That is how much value you are receiving minus what is the cost or what is the price that you have paid. Okay, this is another way to look at it. Now, in most of the questions, in ICA questions, they are very specific. That is, when they say true cost of the merger, true cost of merger is post-merger market cap of the target minus pre-merger market cap, okay, of the target. Now, this is for whom? This is for the acquirer. So, that is the funny part. When the acquirer is evaluating, I also explained to you, the original company was 100, you acquired a company for 10, you gave them a 15% stake in the combined entity, so the combined entity value is 120, 120 may they have a 15% stake, which is 18. Right, now 18 minus, let's say their value, what you think, or the price that you think you have paid, okay, right. So this is the cost of merger for the acquirer, that is post-merger market cap share of the target minus pre-merger market cap of the target. Then what is net gain from merger for acquirer? Synergy gain minus premium paid. So whatever is for the acquirer, what is the gain? See here we said cost of merger for the acquirer. What is the gain for merger from the acquirer? If there is any synergy, synergy minus premium paid. So let's say in the previous case, the synergy, we thought synergy was 1 rupee. Let's say synergy is 20. Okay, 10 is original value, synergy is 20, total value is 30. What is the premium you paid? You paid premium of 20. What is the extra money that you have paid to them? 10 is the value of the original company and their share is 18. So you paid 8 extra, or you've given away 8 extra. Out of total 20 synergy, you have parted off with 8 of extra benefit to them. So your gain is 12. But cost of merger is from a target's perspective. Gain for a merger is from, again, from an acquirer's perspective, where you look at the synergy minus additional premium that is paid to the target, right. Then what is the gain or loss for shareholders of both the firms in market cap terms? It is simple. What is the overall pre-market cap, post-merger market cap? That is the thing. Post-merger share of market cap of acquirer minus pre-merger market cap of acquirer. Same way, post-merger market cap of target minus pre-merger market cap, or post-merger share of market cap. Okay, that is gains or losses for both shareholders in market cap terms. Now, can this gain or loss, can it be in some other terms? Yes, it can also be in terms of share price. How do you do it? Post-merger price per share of A, that is, you have this acquisition, after the merger, the price of the share is 250. Pre-merger, it is 200. Hurry, the share price has gone up by 50, so that is the gain that you made. But this is for the acquirer, this is pre, this is post. But for the target, the post-merger price, you don't have pre-merger price, let's say is 50. Post-merger price you don't have. Why? Because the target no longer exists. So you compute based on the swap ratio that is arrived at. Let's say for every 1 share you get 0.25 shares of acquirer. So 1 share of target is equal to 0.25 shares of acquirer. So for how many shares will you get? For 1 share you will get 0.25 shares. So if you are an original shareholder of the target, out of this 250 value, how much would you have got? You would have got, if you had 1 share, you would have got 1/4 of this, which is 62.5. So originally your 1 share was valued only 50 rupees, but now because post-merger the new company's share price is 250, your 1 share value is 62.5 because you got 1/4 of a share. So your benefit is 12.5. So even in share price terms, this can be seen, even in market caps terms, it can be seen. Now, if you're getting confused, please don't worry. We will be going to solve all these problems. We're going to go in depth to all these issues. So don't worry. I'm just trying to cover the ground, or rather lay the ground for things what you are going to learn. So here I've explained. Swap ratio is 3 shares of target for 2 shares of acquirer. So here I've covered. Post-merger market price per share of equivalent shares of target. So I said no. Equivalent share 1.25 matlab 1/4. So 1/4 of this 250 is 62.5, same way. Minus pre-merger price, share price of T, which is what is, this is 50, this is 62.5. That is how I got 12.5. Now I've given an example. Swap ratio is 3 shares of target for 2 shares of acquirer. So acquirer is stronger. So 2 shares of acquirer is equal to 3 shares of target. There is 1 share of acquirer for 1.5 shares of target. That is, acquirer is stronger. So I will give lesser shares 1, but you will give me 1.5 shares of the target. So assume pre-merger price of 100 of acquirer and 80 of target, okay, and post-merger price of 105. So what happens? Equivalent share price of T is what? For this 105, whatever share is there, you don't, for every share that you hold in target, you don't get 1 share in acquirer. You got how many? For every 1.5, you got 1. So you got 1 by 1.5 share for every one. So for every share you got 0.67 or something. So 105 rupees, out of that 105 rupees, 70 rupees is attributable to you. So 70 is what your share price. But what was your original share price? 80. So what is the loss? You made a loss of 10 for the target. For the target, the loss to shareholder of target is 10. Okay. However, if the same logic is based on equivalent EPS, what did I discuss here? In share price terms. Now, if they say equivalent EPS, that is, what is the gain or loss to shareholder in EPS terms? Same logic. Let's say swap ratio is 3 shares of target for 2 shares of acquirer, same 1:1.5, right? Pre-merger EPS of acquirer is 20 and target is 21. Let us assume the target has a higher EPS, okay? Then post-merger EPS of acquirer is 24. Because you are merging them with you, let's say the post-merger EPS is 24. What is equivalent EPS of T? 24 is the post-merger EPS, but for each share I hold, I got 1 by 1.5 share. So I got 2 by 3rd of a share. So for out of this new EPS of 24, only 2/3 is attributable to my old share of T. So 24 into 2/3 is 16. So my original EPS was 21, now it is 16, so I have a loss of 5. I have a loss of 5, right? Then you have one more thing, maximum exchange ratio acceptable to acquirer. What is the maximum ratio acceptable to an acquirer? What is the ratio? How many shares am I willing to give? From an acquirer perspective, how many shares of mine will I be willing to give to the target? At no loss, no profit. That is the maximum I will give, no? I will share all benefits with you. You can only keep everything. This is the worst. I mean, this is my walk-away price, right? I can't make a loss in this deal, but at least I will not make a profit. So that is the maximum exchange ratio. So all benefits to target and pre-merger value to acquirer. So post-merger also, my shareholders don't gain anything. My pre-merger market cap, post-merger market cap is same. Whereas for the target, pre-merger market cap is far lower, post-merger market cap is higher. If you look this in a market cap term, you can look at same thing EPS terms also. But whatever you do, when they say use the word maximum exchange ratio acceptable to acquirer, you have to understand acquirer gives away all benefits to the target. Then what is minimum exchange ratio acceptable to target? See, if it is for the acquirer, it is maximum ratio. If it is the target, it is a minimum ratio. That is, what will at least how much will I accept? At least the target will accept at least if I get my value. I will not incur a loss. If I am getting the shares, if I am getting so many number of shares such that my old market cap and share of new market cap are same, or old EPS and new EPS are same, then I am okay to accept. So all benefits to acquirer and pre-merger value to the target. Same logic what we saw here. Now, this is from a target and acquirer perspective. What about promoters of target? Minimum value. What is the minimum value that a promoter will do a deal with a acquirer only if the promoter gets at minimum whatever is the income loss that they have because of salaries, values and all, plus whatever is the value of their shares. Market value of shares plus lost income of promoters. Then in case of merger of banks, we will see some question on banks. Capital reserves in post-merger balance sheet is balancing figure. So you will understand this, these two parts, 20 and 21, I will come back to it. Okay, when we solve it, you will try and understand. Right now, I don't want to get into this because we're not immediately going to solve this. First, let us solve problems, focus our problems on M&A related problems, which is non-bank or which is non-restructuring and all of that. Then we'll come to these two. Okay, fair enough. So what are the questions that we have in M&A and corporate restructuring? 1, 9, 12, 14. One is that restructuring question, so we'll keep it aside. Let us first do 9, 12 and 14, then we'll come back to restructuring. So let us look at the first question, which is illustration 9, and this is from study material. The CEO of a company thinks that shareholders always look for EPS. They made their intentions clear. Therefore, he considers maximization of EPS as his company's objective. It's also super clear. His company's current net profits are 80 lakhs. And a PE multiple is 10.5. He wants to buy another firm which has income of 15.75 lakhs and PE of 10. What is the maximum exchange ratio which the CEO should offer so that he could keep his EPS at the current level, given that the current market price of both the acquirer and target are rupees 42 and 105. The CEO borrows funds at 15% and buys out target company by paying cash. How much cash should he offer to maintain EPS? Assume tax rate of 30%. And did they say anything? No, they did not say what is the EPS. But you see, one more point I wish to highlight in these kind of problems. Please write down given data. So M&A and business valuation chapter, and even quite a few other chapters also, but these chapters more specifically because these are format driven questions. Format, F-O-R-M-A-T. That is, if you write down data properly, automatically other data, you can make inferences from the data and it will follow. The entire solution is a step-by-step process. So if you do not write the data, it's gone. What is it that you have to write here? Let us see. First, you write always acquirer and target. If you know the company names also, please write this acquirer, and let's say they give a company name called XYZ, and target, let's say they say PQR. Please write this way. You know very clearly who is the acquirer, who is the target. You need not bother about it subsequently when you are halfway through the question in the exam hall. Okay. So in every question, please make it a point to write down who's acquirer, who's target. It makes life super simple. Now, what is acquirer's thing? Therefore, he considers his net profit are 80 lakhs, PE multiple 10.5. Net profit 80, right? Then PE multiple 10.5. And what did they say? They said price also, no? Acquiring target company prices are 42 and 105. So you please write 42 and 105. Moment you write this, what is it that strikes you? See, you have current market price, you have PE multiple. What is PE is equal to current market price by EPS. So if you know PE, you can find out EPS. So 42 by 10.5, which is how much? 4. Straight away over. Now if EPS is 4, EPS is per share, right? And net profit in lakhs is 80 lakhs. They said no, net profit is 80 lakhs. What is EPS? Net profit divided by share count. So net profit by EPS will give you share count. So net profit 80 lakhs by 4 will give you share count of 20 lakhs. Same thing you do on this side also. So this questions, M&A chapter very, very specifically write down the data. It will make life super simple. So now then what does he say? We've got first point. Then he wants to buy another firm, so and so. What is the maximum exchange ratio he should offer so that he could keep the EPS at the current level? If you want to keep the EPS at the current level, the swap ratio should be based on EPS ratios. What are the EPS ratios? 4 and 10.5. If it is 4 and 10.5, it means the value of EPS of acquirer is 4, target is 10.5. So the swap ratio is ulta. That is 10.5 is to 4. That is 10.5 is to 4 means what? 10.5 shares of acquirer will give you 4 shares of target. So for every 4 shares of target, 10.5 shares of acquirer have to be issued. Because the ratio is 4 is to 10.5, the ratio, swap ratio is ulta. Right. Now, this is the first question. What is the maximum exchange ratio? Already answered. If the CEO borrows funds at 15% and buys out target company by paying cash, what is the value of the target company? They gave here. You have net income is this, 15.75 and PE of 10 and prices 10 and 105. Price is 105, divide by PE 10, you get your EPS as 10.5. From this 10.5, you divide 15.75 by 10.5, you get 15 is the total share count. This share count of 15 multiplied by your current market price of 105. 15 into 105, how much? 15 into 105 is 1575 lakhs. Okay. So what is 105 of market price into share count of 1.5? You get 157.5 lakhs. What is the question that they asked? They are not asking how much should you pay. They are not saying that you should pay this 157. They are asking how much should you pay. If they borrow at 15% and buys out target by company by paying cash, how much cash should you offer to maintain the same EPS? So EPS should not change if tax rate is 30. So interest paid on borrowing is how much? 15%. And you also have a tax benefit of 30%. So the net interest paid is 15 into 0.7, which is 10.5%. Okay. Whatever is the borrowing you make, on that you pay 10.5% interest. And the 10.5%, what is the pre-merger combined profits? We computed net profit of 80 lakhs here and 15.75 lakhs. So post-merger combined profits is 80 plus 15.75 net profit again. That is 95.75 lakhs. Now from this you have to subtract the interest. Okay, we will see what is the interest cost. We arrived at interest cost, 10.5% of whatever is the borrowing. And what is the borrowing value? Borrowing value is the amount of cash paid. But after subtracting that, your EPS has to remain the same. For your EPS to remain the same, has your share count changed? No. Share count of 20, which is the acquirer's share count, will remain the same. Why? No shares are issued to the target. Why? Because target is bought out on cash basis. So no shares are issued to the target. So same 20. So 95.75 is PAT minus 10.5% of borrowing divided by your existing share count of 20 should give you the same old EPS. What is old EPS? 4. So 95.75 minus 10.5x by 20 should equals 4. You should solve for this. So if you solve this, what you'll get is value of x is 150. That is, you have to borrow, or rather you have to borrow 150 crores and make a cash payment. If you're borrowing 150 crores, how many shares are here? 1.5 lakh shares. So 1.5 lakh shares, each share you should buy at 100 rupees, right? If you have to pay 150 lakhs divided by 1.5, you have to pay 100 rupees per share. What is the market price per share? 105. So which is, when you multiplied this 105 with 1.5, you got 157.5. But now you are multiplying 100 with 1.5, that is, only then you are getting 150. That is, you have to make a payment that is lower than the current price of the share of the target. Current price of the share of the target is 105, you are making 100 rupees payment. Overall, you are making 150 lakhs payment. So this is what you have to answer. That is, the amount of cash to be paid is 150 lakhs, as that the EPS pre and post merger are the same. So is that a specific question? How much cash should he offer to maintain EPS assuming tax rate, to maintain his EPS assuming a tax rate of 30%? This is exactly the answer. You can state overall cash value also, and you can also say and per share price of rupees 100. That also you can mention. Okay, this is illustration number 9. Now let us go to illustration number 12. Again, this is also an interesting question. XYZ Limited wants to purchase ABC. What is the first thing? XYZ is acquirer, ABC is target. By exchanging 0.7 of its shares for each share of ABC. So they will give lower share, they will give more, they will get more from ABC for one share. So they are giving away 0.7 share, getting one share. Okay, now equity shares outstanding is 10 lakhs, 4 lakhs. This is acquirer XYZ. This is target ABC. EPS is 40, then 28, and market price is 25, 160. If you have EPS and market price, you can arrive at PE. Then you can also multiply EPS with share outstanding, you can get the PAT. You can multiply PAT with PE ratio, you can basically get the market cap. Okay, so illustrate the impact of merger of EPS on both the companies. We will see that. The management of ABC has quoted a share exchange ratio of 1:1. So the target is saying I want 1:1. Assuming that the PE ratio of XYZ will remain unchanged after the merger, what will be the gain from merger for ABC? This is why I said I wanted to teach you that concept first. What is the gain? Right? Then what will be the gain loss to shareholders of XYZ? We will see. Determine the maximum exchange ratio acceptable to shareholders of XYZ. XYZ is, these both are acquirers. And this is target. ABC is target. Correct? Correct. So friends, what do you do? First, write down the data. Who's the acquirer? Who's the target? XYZ is the acquirer, target. See, that is what first thing I write. Then shares outstanding 10 lakhs, give everything in lakhs. EPS is 40. So PAT is EPS into share outstanding, which is 400 lakhs. Market price per share they have given us 250. So PE ratio is market price divided by EPS, which is 40. You get 6.25. Same way you do for other also. 4, 28, 112, 160, 5.71. What is market capitalization? Your PE ratio into PAT, that is 6.25 into 400. That is one way. Or it is also your shares outstanding into market price per share, 250 into 10. So 6.25 into 400 also will give you 2500, and 10 into 250 also will give you 2500. Then shares issued to ABC. How many shares? 1.7 for everyone. How many shares are there? 4 lakhs. So for 1, you will give 0.7. So for 4, you will give 4 into 0.7, which is 2.8 lakh shares. So what is the revised share count? Original 10 plus 2.8 will make it 12.8. Okay, 12.8. Now what is post-merger EPS? How will you arrive at post-merger EPS? You will arrive at post-merger EPS by combining post-merger, by taking post-merger PAT divided by post-merger share count. What is post-merger profit? You have 400 plus 112, directly add both of them, which is 512. 512 divided by 12.8, you get an EPS of 40. So EPS is 40, post-merger EPS is 40. Then why are we doing all of this? They said impact of merger on EPS of both the companies. Pre-merger EPS is 40, post-merger EPS is 40 for acquirer. So there is no impact. For target, pre-merger EPS is 28, post-merger EPS is how much? Post-merger, see, EPS is 40, but they have got for each share of theirs, they have got only 0.7 shares. So this into 0.7 is 28. So post-merger EPS, that is the equivalent shares of ABC, equivalent shares of the ABC, that is equivalent shares of the target company, the value is 28. So pre-merger EPS is 28, Post merger EPS also 28, so there is no change. So what do? Both shareholders have no impact. This is on EPS basis, because why they specifically ask what is the impact of merger on the EPS. Second question is, let me clean this up. The management of ABC has quoted share exchange ratio of 1:1. So the target is saying I want 1:1. Assuming that PE ratio will remain unchanged of the merger, what will be the gain from merger for ABC? So if you go ahead with this 1:1, what will be the gain? If you go ahead with this 1:1, what will happen? Your more shares will be issued. Why? Because when 0.7 lesser shares, 1:1 more shares. How many shares? Because shares outstanding is 4, you will issue 4 lakh shares. Originally is 10, so total is 14 lakhs. What was old EPA? Old PAT? Old PAT is 400 plus 112. Same 512 will be the new PAT also. Right? Divided by 14 will give you new EPS. What is new EPS? 512 by 14 is 36.57. Right, what was the old EPS per share? Old EPS was 28. So what is the increase? Increase is 30.61. In what terms? Management of PS quoted so and so, XYZ will remain unchanged merger. What will be the gain from merger for ABC? So gain in EPS terms. Gain in EPS terms is 30.61%. What is the gain in overall value terms? Overall value terms, your EPS is 36.57. What is the PE is 6.25. So what is the market price? Market price is 36.57 into 6.25. It will be 228.56. How many shares? Shares are 14 lakhs. So market cap is 228.56 into 14, which is 3200 lakhs. Market cap is 3200 lakhs. Now, if 3200 lakhs is the market cap, what are the shares held by the ABC, which is the target? We have issued 4 lakh shares, correct? So 4 lakhs out of 14, 4 by 14 is how much? 4 by 14 is some 28.57. So 28.57% into overall market cap of 3,200 is how much? 914. 914 lakhs is the market cap, or rather the share of market cap held by the shareholders of the target. What was their original market cap? Original market cap was 640. It has increased to how much? 914. What is the increase? 914 by 640 minus 1. So 914 divided by 640 minus 1. You get 42.86%. So from a market cap perspective, because PE ratio is remaining the same, the gain to the shareholder is 42.86%. But from a EPS perspective, it is only 30%. We arrived at 42.86% as the gain to shareholders of the target. Can we do it in some other way? We can do it in one more way, which is, what is post-merger EPS? 36.57, which we already arrived at. What is PE and price? We already arrived at 228. Because 1:1 is the exchange ratio, you need not compute this market cap. You can directly say, my old share was 160, because 1:1 is the exchange ratio, new share is 228, so I have made a 68 rupees gain. This 68 on 160 is a gain of 42.86. I need not compute this market cap, share, 44 by 14 and all of that. That also need not be done. You can directly compute this way. You can directly compute the gain ratio as 42.86% for shareholders of the target. Now, what is the next question that they have asked? What will be the gain loss to shareholders of XYZ? That is, acquirer, what is the gain loss? See, from an acquirer perspective, original share price was what? 250. Revised share price is what? 228. There is a reduction of 21 rupees. Directly on a share price basis itself, it is 21 rupees. Now, this 21 rupees, 21.43 divided by 250 is how much? You get some 8.5%. So 8.5%. This is a reduction in share price. For in a market cap basis, will it be different? No, it will not be different. See, because for out of this 3,200, which we found out the revised market value of both the companies, 3,200 into 10 divided by 14, you'll get what? 2285.7. 2285.7 is what? Is the new market cap. 2285.7 is the share of the original shareholders in the new company. Right. What is their old market cap? Old market cap is 2,500. So 2,500. 2,500 and 2285. Here also what did you do? 250 and 228.57. So the numbers, the difference in numbers is only 1/10. That is 228.57 versus 228, 2,500 versus 250. So there also you'll get the same, 8.5% reduction in value per shareholder of XYZ, the acquirer, post the merger. If you do it in per share terms or market cap terms as far as the acquirer is concerned. Then what is loss in EPS terms? This is what I was saying. When they ask you a question where they don't specify whether the loss is in terms of EPS or market cap, you have to compute both. So what is in EPS terms? What is their pre-merger EPS? Pre-merger their EPS was 40. What is post-merger EPS? Post-merger we computed the EPS 36, no? Yeah, 36.57. So it has reduced. So 40, 36.57, this is 3.43. So 3.43 divided by 40. Reduction of same 8.5758%. Okay, so this is the reduction for the acquirer XYZ when this merger goes through at a ratio of 1:1. Now, what is the next question that they asked? Determine the maximum ratio acceptable to shareholders of XYZ. This is the question. What I am saying is not clear. What is the maximum ratio? Is it in EPS terms or is it in price terms? Because market price terms it is different, EPS terms it is different. See, initially we said 0.7, at 0.7 there was no impact. Both shareholders have no impact if the exchange ratio is 0.7 on EPS. So that is very clear. On EPS basis, if shareholders should not lose, then swap ratio is 0.7 of XYZ for one share of ABC. Why? Because we have already computed in part 1 that there is no change in EPS if the exchange ratio is 0.7:1. So what should be the exchange ratio if there should be no impact on the share price? That is, or the value, right? On the market price basis, there should not be an impact. See, this is what is a critical part in questions like this. So, what is PAT of merged entity again? You have to again, for everything, you have to come back from starting, 512. What is the PE multiple? 6.25. So, you get the market capitalization of 3,200, right? And here you make an assumption that the PE multiple remains same. Otherwise, there is no point, no fun in doing this exercise. Otherwise, how will you do this exercise if you don't assume PE multiple remains the same? If it is just summation of market caps, then it does not make any sense. So, you have to assume that the PE multiple remains the same, then compute the revised market cap, then old market cap. So, please note what is the question? The question is maximum ratio acceptable to XYZ, that is where they don't lose out, that is entire gain they give off to the other company, that is this entire 700 whatever is the gain is there in market cap, right, is attributable to the target. So, target attributable value is 700 and how many shares are, at what price are you issuing shares? You are issuing shares because it is a share swap, you are issuing each share at 250. Where is this? 250. Let me clean this up. So, each share you are going to issue at 250, right, that is the current market price. So, 700 shares for 250 rupees share price, you will get 700 by 250 which is 2.8 lakh shares. So, 2.8 lakh shares you are issuing for how many shares? For 4. So, 2.8 out, 4 in, that is 2.8:4, that is 0.7. So, this also is 0.7:1. So, swap ratio, if the price also has to, on an EPS basis also where the acquirer does not lose out on price, the ratio is 0.7:1. It is very, very clear. So, both the cases the answer is 0.7:1. Where is this? In EPS base also 0.7:1 and the share price also 0.7:1. This is one single question in which you will understand half the concepts of this chapter what we discussed. This is why I actually chose this question number 12, because you will understand. Now, if you have any doubts, please go through this question again. Okay, what I have solved, what am I saying, what is actually there in this booklet that I am sharing with you, P600 plus. Please go through that again. Ask me if you have any doubts. You can ask me in forums or you can ask me, below this video, clicking, ask query or comment, and I will be able to respond. Okay, this is one question that will solve all your doubts, complications, confusion, everything with respect to this particular chapter. Everything with respect to this particular chapter. Okay, now we've solved question number 12. Let us go to next question. This is question number 14. This is also something similar. Let us see. Following information is provided related to acquiring company money. Money is the acquirer. First I will write acquirer. Target company Ratnam, target, written. EPS, EAT. EAT means PAT. PAT is 2000 lakhs, 4000 lakhs. Shares outstanding 200 lakhs, 1000 lakhs. PE ratio 10, PE ratio 5. Does it not sound weird that as a company which is small, which has lower PAT, is acquiring a bigger company? Probably because it is higher valued. Let us see. What is the swap ratio based on current market prices? What is the EPS of money after the acquisition? What is the expected market price of share after acquisition assuming PE ratio is adversely affected? Then determine the market value of the merged company. Calculate gain loss for shareholders of independent entities due to merger. Now, again, this gain loss to shareholders, did they say EPS or market price? We don't know, so you have to compute both. What is swap ratio based on current market price? What is the current market price? So first you put the given data, 2,200. 2,200 number of shares. PAT is 2,000. The shares outstanding is 200. So EPS is 2,000 by 200, which is 10. Okay, and they've also given PE ratio as 10. So 4,000 by 1,000 is equal to 4, which is the EPS. 5 is the PE ratio. So the market price is 4 into 5, which is 20. Market price is 10 into 10, which is 100. 100 is to 20. Market prices are in the ratio of 100 is to 20, that is 5 is to 1. So see, that is what I was telling you. This company which has higher profits is quoting a lower price because of low PE multiple. So 100 is to 20. So swap ratio is 5 is to 1. That is for 5 shares of the target, you will issue 1 share of the acquirer. But you see, market cap basis, both of them are same. 20,000, 20,000. How did I get market cap? Market cap is PAT into PE. What is PAT here? 2,000 into PE. PE is how much? 10. Right, that is how I got the market cap. Now, first part of the question we answered. What is the swap ratio? What is the EPS after acquisition? So, if this is the ratio that goes, they have not said anything else. I mean, question number 2 is after question number 1. So, you have to automatically assume that the swap is based on market prices. What is EPS of money? Money is whom? The acquirer after acquisition. What is the combined PAT? Combined PAT is this 2,000 plus 4,000, which is 6,000. Okay, now that is combined PAT. Now what is the revised share count? See, for you to compute the EPS of money, they have asked that question, no, what is the EPS of money? You need a revised share count. How many shares are you issuing? For 5, every 5 you are issuing 1. How many shares are there? There are 1,000 shares. So for 1,000 by 5 into 1, you will issue 200 shares. You issue 200 shares. What is the original share count of money? Original share count of money is 200, new shares issued is 1000 by 5, which is 200, so total share count is 400. What is the revised EPS? Revised PAT by revised share count. What is revised PAT? Just now I said 6,000. How did I get 6,000? You added both these PATs. They have not given synergy value, so we will not take anything. 6,000 by 400, so revised EPS is 15. 6,000 by 400 is 15. Is that the question that they asked? What is the EPS? We said 15. What is the old EPS? Old EPS we computed here was 10. It has increased to 15. Okay. What is the expected market price of money after acquisition? Assuming its PE ratio is adversely affected by 10%. Adverse means it comes down. Comes down by how much? Comes down by 10%. So what was the original PE ratio? Original PE ratio was 10. So it comes down by 10%, becomes 9. So your revised PE is 9. What is the revised price? Revised PE into revised EPS. So please remember this. PE is equal to price by earnings. So if you know this as 9, if you know the earnings as 15, price is just cost multiplication. 9 into 15, 135. What is the old price of the share? Old price is 100. What did they ask? What is the expected market price? Expected market price has gone up from 100 to 135, right? After acquisition, it has become 135. Then what is the next question? Determine the market value of the merged company. Well, how will you determine the market value of the merged company? Now, this should be following number 3. Question number 4 is after 3. What is market cap formula? Market cap is equal to share count into share price or PAT into PE. You can compute either way. Why? PE is price to earnings, okay, into PAT. What is PAT by earnings is share count. So share count into share price, which is what I did here. So either ways you can compute. Now, what was the specific question? Market value. What is market value? You can compute it. You have all the required data. That is share count also you have. You have total shares is 400. Right, and share price. Share price also you have as 135. So 400 into 135, which is 54,000. That is one way. Or you can do this. PE ratio into PAT. What is revised PAT? Revised PAT is summation of both the PATs, which is 6,000 into new PE is 9, so 54,000. Either ways you do, you will get the same thing. Okay. Then coming to the next part. Calculate gain loss for shareholders of independent entities due to merger. Now, what should we follow? Should we follow this reduced PE by 10%? Should we not follow it? Should we follow what? So this is following, or rather this question number 5 is after 3 and 4. So So you should follow necessarily that reduced PE. So you should necessarily follow the reduced PE wala logic. Now, what is the specific question again here? Calculate gain loss. Now this gain loss is on EPS, gain loss is on share price. First point when I read this question also, I told the same thing. Is this on EPS terms or is this on price terms or market price terms or share value of the shares terms? You will compute both. Always do both if you have time. Okay, unless they specify. If they specify in EPS terms, then you do only EPS. But if they don't specify, do both. So what is old market capitalization? 20,000, 20,000. We already found out. What is the new shares held? Both of you hold 200 plus 200, half. So what is your market cap? 27,000, 27,000. So how much is the increase in market cap? For both of you, it is 7,000 is the increase in market cap. But are we looking at market cap terms or price terms? It is in price terms. So this 7,000 divided by 200, which is the number of shares that you have. 7,000 divided by 200, which is the original share count. So increase in value per share is 35. So this 135 has increased from 100. So for you, the increase is 35%. For the other party, what was the original share price? Original share price was only 20. But 20, you got 5:1. So for every 5, you got 1. 5 shares of 20 give you 1 share. So 1 share of new entity is 135 and 5 shares of old entity is 100. So for you also, the increase ratio is same 35%. You can do it the other way also. That is 7,000 is increase in value. 7,000 by 1,000, that is shares held is 7. This 7 divided by 20, which was the original share price, will give you 35. Either way, you will get the same answer. So increase in share price per unit share price or equivalent shares or increase in price per equivalent share is 35%. That is not an issue. Now come to EPS front. What is EPS? What is a combined PAT? We arrived at combined PAT, no? 2,000 plus 4,000, 6,000. Okay, 6,000. Now what is pre-merger EPS? 10 and 4. Okay, what is pre-merger EPS? 10 and 4. What is post-merger EPS? We already found out somewhere. Where? 15 rupees, no? Post-merger EPS, 15 rupees. Right. So this 15 rupees is post-merger EPS. So for acquirer, it has gone up by 50%. From 10, you have gone up to 15. But for the target, what has happened? Pre-merger EPS is 4. But for every 5 shares of yours are combined together and issued, 1 share is issued. So pre-merger EPS for 1 equivalent share of the acquirer is 4 into 5. So originally, the target had EPS of how much? 4. But 5 shares were combined together to issue you 1 share. So your equivalent EPS is 20. That EPS has now come down to 15. So what is the reduction? Reduction is 5 upon 20, which is 25%. This is one way. Another way is, you had per share you are getting EPS of 4. New share EPS is 15. But new shares you got 5, for every 5 shares you got 1 new share. So per old share equivalent EPS is 15 by 5, which is 3. So you compare 4 versus 3, it has dropped down by 1. 1 upon 4 is 25%. So you can do this way also, you can do that way also. Okay. So on EPS basis, for the acquirer, EPS has gone up by 50%, whereas for the target, it has come down by 25%. Whereas on a price basis, for both of them, there is a 35% increase in the value of the share price. Okay. Whether it is share price or whichever way you want to look at market cap terms, either ways, it is fine. Okay, fair enough. So this is how you solve this problem. Again, this also is one question, question number 12 and 14, which will solve all your doubts, clear everything. Everything will become crystal clear if you understand these 2 questions. Okay, if you're not able to understand, please, pause my video, go back, put pen on paper, you solve it on your own. You will understand, and then everything will be simple in this chapter. Okay, now let us move to the next question. What is the next question? Question number 18. So now let us move to this question 18, illustration 18. P Limited is considering takeover of R Limited by exchange of 4 shares in P for every 5 shares, not 1, every 5 shares in R. So P is the acquirer, they will give 4, they will take 5. The relevant financial details of 2 companies prior to merger announcement are as follows. PBT, not PAT, PBT. Okay, 15 and 13.5. Shares in crores, everything is in crores here, 25 and 15. PE ratio is 12 and 9. Corporate tax rate is 30%. Market value of both the company. How do we know market value? You have PE, you have EPS, multiply PE by EPS. Value of original shareholders market cap. Price per share after merger, that is after the exchange, what is the price per share? So here, how do you compute price per share after merger? In these kind of situations, you assume that the original acquiring company PE will continue. Okay. Then effect on share price of the company, the directors of PE expect their own PE ratio to be applied to combined earnings. So both for 3 and 4 you should use the same PE. Now, what is PBT? 15 and 13 and a half. Then you subtract 30% tax. You get 15 minus 30% is 10 and a half. 13 and a half minus 30% is 9.45 crores. Then you have shares, 25 crore shares, 15 crore shares, and you compute the EPS, that is PAT by the share count. You get 10.5 by 25 is 0.42, 9.45 by 15 is 0.63. Please be careful with decimals. Okay, and what is the PE ratio? PE ratio then itself given as 12 and 9. So into 12 into 9 you get some share price 5.04 and 5.67. Then what is the market cap? Your PAT into PE. You can do this as PAT into PE. What is PAT? 10 and a half into 12, that is one way, or you do your market price into share count. What is share count? Share count, this 25 into 5.04. So 25 into 5.04 is 126, or 10 and a half into 12 is also 126. Same way here, same way here. So what is the first question? Market value of both. Done. Value of original shareholders. What do you mean by the value of original shareholders here? When they are saying value of original shareholders, post acquisition, right? Post acquisition, post the swap, how much of value of the total market cap is retained by each? So what is existing share count? Existing share count is 15 of the acquirer. What are you doing? For every 5 shares of P, you will issue 4. So what is existing share count of R? Existing share count of R is 15. Please be very careful. 15. And what is the ratio? For every 5 you will issue 4. So 15 by 5 into 4, which is 12. So you will issue 12 in addition to original. Original how much? Original was 25. So 25 plus 12. Okay, 37. 25 plus 12 is 37. Now 37 lakh shares. Right. Now what is the stake of original people, original the acquirer? 25 by 37. What is the stake of target? Balance 12 by 37. So 25 by 37 is 67%, balance is 32%. You can do overall market cap basis also, or you can directly do it on the basis of the shares that are held. Directly doing on the basis of the shares that are held is simpler. You need not multiply unnecessarily with prices and all of that. Okay, this is first one part. Then price per share after merger. What is the price per share? See, you have PE ratio of 12 and 9. Here you have to make an assumption that the PE ratio will continue. Why? Otherwise, how will you determine the price? Right? You can't just add the market caps and then divide by the share count. Right? So post merger PAT is 10.5 plus 9.45. We already computed these two, so you will get some 19. And what is the post merger share count? Is 36. So you divide the PAT by number of shares, you get EPS. What is EPS? EPS is 0.54. This 0.54 you will multiply with the PE ratio of the acquirer. What is the PE ratio of the acquirer? 12. You assume that the acquirer PE ratio will continue. So 12 into 0.54, 6.47. So what is the question that they asked? Price per share after merger. Price per share after merger is 6.47. Very, very clear. You have to assume that the PE ratio will continue. You cannot make an assumption. See, I will tell you what you should not do. Okay, not do. I am writing it clearly. You should not do this. What you should not do is, you cannot say PAT is 19.95. Market cap is, what is the market cap? Just combination of these two market caps. What is these two market caps? 126 and 85. So post merger market cap is 211.05. This is PAT. Then you have share count. Share count is 37. Now what did they ask? Post merger price. What is post merger price? Market cap by share count. You cannot do 211 divided by 37 and say 5.7. No. Why? Because this market cap, the market will depend on your swap ratio. You have issued 12 lakh shares. These 12 lakh shares will have an impact on price. So you cannot take the old market cap as a reverse market cap. Okay, combination of two market caps is not the final market cap. This most likely will have an impact. So which is why what you do is you take the PAT. From the PAT you arrive at the EPS. Multiply the EPS with the old PE. You say that, you can always claim that why PE will also change. Yes, PE can also change. But here they have not mentioned that PE will change. So you specifically make an assumption that this PE will not change. Right? And then you say 6.47 is the price. Right? Then what is the next one? Effect on share price of both the companies. Directors expect their own pre-merger EP to apply to combined earnings. That is exactly what I am saying. Effect on share price. So what is the share price? Share price is What is the specific question? Effect on share price of both the holders of both the companies. Price per share. Originally, pre-acquisition is for P, that is the original acquirer. Acquirer is P, right? Current market price 5.04 and 5.67. You first plot those two, 5.04, 5.67. Then this 5.04 has increased to 6.47. How did it increase to 6.47? We just now computed. But for an equivalent share, what is the price of for the target? 6.47 is for one share, but for every 5 they got 4. So divided by 5 into 4, so they got lesser. So 5.176 or 5.18. So their 5.67 value has come down to 5.14. That is a reduction of 8.71%, whereas for the acquirer it is an increase of 28%. This is the impact on the price. Now we've computed this 67 and 32 here by directly taking the value number of shares. Can we do it in another way? We can do it in another way. I'll show you what is that. That is pre-merger, what is the market cap? What is the market cap? Market cap is what? 126. We got it here, no? 126 and 85. So you put the pre-merger market cap. Total is 211. This is what I was telling you. You shouldn't take that, market cap will be the same. Post-merger, because the price has gone up to 6.47, 6.47 into 25 and 6.47 into 12. So your market caps have increased. So overall market cap is 239. So if you look at this 161 by 234 and 77 by 234, you'll get 67% and 32%. Same thing what you did with the share count versus same thing what you did with the market cap. You'll get the same 67 and 32% ratio. Okay. So post-merger price of P is computed using post-merger PAT and dividing by post-merger share count, arrived after considering swap ratio of 4 shares of P for 5 shares of R. Post-merger equivalent EPS of R is arrived by adjusting swap ratio of EPS on the combined entities. In the market is aware that shareholders of P will gain and shareholders of R will lose. The price of P will move up by 28%, price of R will go down by 8.71%. Did they ask for that kind of thing? Effect of share price of both the companies, directors. So they not only said what will happen, so we not only are supposed to find out what is the gain loss, we have found out here gain loss. Because there is going to be this gain loss, the prices will move in advance. Prices will move in advance. That is the point I am trying to communicate here in the last line. Because somebody is going to gain, somebody is going to lose, the prices will react to that particular information. So this is the key point in this. Okay, now after finishing question number 18, let's go to question number 20. So friends, now let us move to the next problem, which is illustration 20. Yes Limited wants to acquire No Limited, okay, and cash flows of Yes and the merged entity are given below. This is the original cash flow of Yes and post-merger, what is it? Okay, now this is post-merger. So please be careful. The question is actually slightly twisted. Earnings would have witnessed 5% constant growth rate without the merger. So this Yes Limited, is this before or after merger? This, if they have given Yes Limited's cash flows, it means it is before merger. So this is before merger. Merged entity, is this before or after merger? This is after merger. Correct. And this earnings would have witnessed 5% constant growth rate without merger and 6% with merger on account of economies of operation after 5 years in each case. So before merger 5%, after merger 6%. Okay, this is what it means. Okay, it's a very convoluted way of giving. So in fact, first time when I read it, I got confused. What is it that they're trying to say? The cost of capital is 15%. The number of shares outstanding in both the companies before the merger is same. And the companies agreed on exchange ratio of 0.5 shares of Yes for each share of No. So let's say No has 1 share, this has 0.5 shares. So this also has 1 share, I'm sorry. So 0.5 shares are allotted for every share. So total share count is 1.5. Okay. Present value of at 15% is 0.8776756, so on and so forth. You are required to compute the value of Yes Limited before and after the merger. Okay, and value of the acquisition and gain to shareholders of Yes. Now this is a very interesting question. I purposely chose this question because it's the first part itself is very confusing and twisted. So is this what is going to grow at 5%? Yes, because pre-merger this is the number 350, post-merger 620, that is after combining with No. So now this 340, 350, it would have grown at 5% without the merger and grow at 6% with the merger. So is this 6% only for the no limited and yes limited merged entity, or is it for yes limited cash flows also? It can potentially be for yes limited cash flows also. This before merger 5%, after merger 6% is for this as well as this. Okay, a very interesting question. Let us see. See, one very simple thing in these kind of questions. First, put some data on pen and paper. You will automatically start understanding what you're supposed to do. So, we have 5 years present value factors. One is cash flow of yes. This data we know, they've given 175, so on and so forth. Other one is cash flow of merged entity. That also we know. Find out the present value of both these cash flows. Multiply 175 with the 0.87, so on and so forth for each one. And then multiply with 400, 450 also. You will get some present value of cash flows. Now, these present value of cash flows, please note, this 5% and 6% growth rate is after 5 years. So, these cash flows, you have to take them as it is. And after the 5th year, the perpetual growth rate or terminal growth rate is 5% and 6%. So, your cash flow total present value of cash flows here is 800, here it is 1600. Now, this 800, this Y limited has two options. It can grow at 5%, it can grow at 6%. Okay. Now, if it grows at 5%, if it were to continue to grow at 5%, what is the last year cash flow? 350. So, 350 into 1 plus 5% divided by 15 minus 5. Why am I taking 15? 15 is the present value factor, cost of discounting, whatever is the discounting rate. So, you get value of 3675. This is yes limited before merger or without merger at 5%. Do we need to compute yes limited 6% after the merger? What are the questions asked? Compute the value of yes before and after. Okay, before and after we will see. Value of acquisition we will see. Gain to shareholders we will see. Now, when you are computing before and after merger, okay, do you need to simply put this 5% in one case, 6% in another case? Before merger 5, after merger 6, let me compute the differential in terminal value. Is that the way to do it? No, it is not. Why? I will tell you. Let us first proceed with this 5%. Okay. You compute with this 5%, you get a present value factor of 4.497. Use the 5th year cash present value factor. Multiply with 3675, which is the terminal value. You get 1826. This is the pre-merger yes limited. Now, post-merger combined entity is going to grow at 6%. Is going to grow at 6%. So, that will be 7302. Again, present value factor, you get 3629. Okay. We have just computed value of the combined entity. Value of this is combined entity. This is only yes with no merger. This is combined entity, obviously with merger, that is 6%. Here it is 5%. So far, okay. Now you see, you add this 1800 to this 882 and 1600 to 3629, you get the combined value 2708 and 5308. Okay. Once you add this, what is the questions that they asked? First, let us see. What is the gain to shareholders of yes? What is the value of acquisition? Compute the value of yes before and after. Now, the exchange ratio is for every 1 share of no limited, you get 0.5 shares of yes limited. So, what is their proportion or of the overall value of the company? 2 by 3. What is their proportional value? 2 by 3. So, can you not say that this 5308 into 2 by 3, right, is the value attributable to yes limited? Yes, you can say that. But, yes, you can say that. That is one part. What is the second part? Value of yes before and after merger. So, before merger is very clear, 2708. After merger is how much? 5308 into 2 by 3, which will be 3538. How did I get? 5308 into 0.66667. Okay, 3538. 3538. Okay, this is the value post the merger. What is this? Is value pre-merger. This is the value post merger. What is the specific question they asked? Value of yes before and after computed. Value of the acquisition. What is the value of the acquisition? How much did you acquire it for? What is the overall value that you acquired it for? What is the value that you acquired it for? So, the value of shares of no limited in the combined entity is how much? 5308.4744 into 1 by 3. That will be 1769.491. Okay? That will be 1769.491. This is value of the shareholding of No Limited in the final company, combined entity. Okay. What is the gain to shareholder? It's a simple difference of this 3538 minus 2708. What is 2708? 2708 is pre-merger value. So what is the gain to them? 830.068. 830.068. 3500 minus 2700. Now here we have also computed one more thing. What is value increase or accretion due to acquisition? Did they ask that question? No, they didn't ask. I just had computed it and given it. The value increases from 5308. From 2708 it has gone to 5308. So the increase is 2599. Out of this 2599, everything does not belong to them. Some belongs to no shareholders, some belongs to yes shareholders, right? Because this 5308 pertains to 5308 has cash flows of No Limited also, right? So out of this 2599, out of this 2599.5594, roughly 1769. How did I get this 1769? Your 5308.4744 into 1 by 3. That you will get as 1769.49, okay, 49147 or something. This belongs to No Limited. I'll highlight this. This belongs to No Limited, and balance, whatever is the balance, that only belongs to Yes Limited. So out of this 2599, 1769 belongs to No Limited, balance belongs to Yes Limited. After 20, let us go and look at question number 25. T Limited and D Limited are in the same industry. The former is in negotiation for acquisition of the latter. So T is acquirer, E is target. Important information about two companies as per latest financial statement is given below. Equity shares outstanding, you have 12 lakhs and 6 lakhs. Debt, you have 580 lakhs, and 240 lakhs. EBITDA is 400 lakhs and 115 lakhs. Market price per share is 220 lakhs, 220 and 110. Right. T plans to offer a price for E business as a whole, which will be 7 times EBITDA reduced by outstanding debt to be discharged by own shares at market price. So you are valuing this company at something which is 7 times its EBITDA minus the debt value. Whatever is the consideration is basically your market cap. That you will discharge by issue of own shares, and these shares are issued at same market price of 220. That is the logic. E Limited is planning to seek 1 share in T for every 2 shares in E based on the market price. Tax rate for the two companies may be assumed at 30%. Calculate and show under following under both the alternatives. T Limited's offer in E Limited's plan, which is net consideration payable, number of shares to be issued, EPS of T after acquisition, expected market price per share after T after acquisition. State briefly the advantage to T from the acquisition. Calculations except EPS may be rounded off to 2 decimals in the table. First thing, as I said, please note down everything in a table. What is share capital? 12 lakhs. Then face value. Did they say mention face value? 10 rupees face value. 10. Borrowing 580 and 240. EBITDA is 400 and 115. Now, what is the interest expense? Interest expense is whatever is this 10% on 580, which is 58, and 12.5% on 240, you get 58. From EBITDA, you subtract interest, right? You get EBIT. From EBITDA, you subtract interest. But what about depreciation? Have they given a depreciation number here? Why is depreciation number even relevant to us? See, they said what is the EPS of T after acquisition? How will you compute EPS? EPS is PAT by share count. But PAT ke liye you need from EBITDA you need to work down to PAT. Do we have the tax number? Tax number they have said is 30%. So tax is not an issue. Interest we can compute. What about depreciation? We don't know what depreciation is. Okay, so you have to make an assumption that depreciation is required. Depreciation is required because it is not provided, it is 0. So you subtract interest of 58 from EBITDA, you get you treat that as PBT 342. From 342 you subtract 30% tax, you get PAT of 240. PAT of 240 divided by 12 lakh shares, you gives you an EPS of 20. What is the current market price? Current market price they have given us 220. So 220 by 20, P is 11. Same logic you work out here also. You get interest of 30, subtract 30, you get PBT. From PBT you subtract tax, you get the PAT. PAT is 60. 60 divided by the share count of 6, you get EPS as 10. 10 and the price is 110, so your P ratio is 11. Now, they have said two methods of valuation. First one is EV by EBITDA, other one is share exchange. If it is EV by EBITDA, what is it? EV by EBITDA multiple of 7. What is the EBITDA of the target? 115. So 7 into 115 is 809. From that you subtract the debt, which is 240. You get 569. 569 is the total value of the company, of the equity shares of your target. What is the name of the target? I keep forgetting. E Limited. Target value of shares of E Limited that you have to pay is 569.97. Now, this is in what? In lakhs. What is per share price of T, which is the acquirer? They said the consideration is discharged by issue of its own equity shares. So, you will issue equity shares worth of each share at 220 rupees. So, how many shares do you have to issue? You simply divide by 569.97 by 220, you get 2.59 lakh shares. They said round off to 2 decimals, so we will round off to 2. And this is 2.59 lakh shares that you have issued. What are the points that they are asking? They are saying net consideration payable, we have computed. Number of shares, computed. EPS of T after acquisition. What is the EPS? EPS is whatever is the combined PAT. What is the combined PAT here? 240 plus 60. Why? Because we have already found out here where 240 and 60. So 300 divided by original share count plus new shares issued. Total shares is 14.59 lakhs. You divide 300 lakhs by 14.59, you get 20.56. Okay, 20.56 is the post-merger EPS. What is the pre-merger EPS? Pre-merger EPS is 20. Expected market price per share of T after acquisition. See, here, thankfully, fortunately, both T Limited and D Limited have same PE ratio of 11. We computed, no? Computed here. And they've also not said what is going to be the new PE ratio. So, you can safely assume that the same PE ratio will continue, which is you apply this EPS of 20.56 on your multiple, PE multiple. 20.56 into 11 is 226. But is PE the only way in which we should value? Probably the company may trade at EBITDA multiple. How will you compute the value of this business using EBITDA multiple? See, you have the market capitalization of T pre-merger, which is 2640. How did I get 2640? You have share count. What is the share count? Share count is 12. What is the market price? 220. So, 12 into 220 is equal to 2640. This 2640 is market cap. What is the debt? Debt here we have is 580. So, 2640 plus 580, which is what? 3220. Right. This 3220 implies what EV by EBITDA multiple, because what we have 3220, what we have compared is EV. This EV by EBITDA, what is its EBITDA? Its EBITDA was 400.86. So, if you compute EBITDA multiple of acquirer, which is T, you get 8.03. So, if the PE multiple only is applicable, have they mentioned anywhere saying that which will be 7 times EBITDA discharged, he is planning to seek 1 share, show how both are alternatives? They did not say expected market price of T after acquisition, use only PE method. So, you compute the original EV by EBITDA of the acquirer, which is T Limited, apply the same EV by EBITDA multiple for the revised EBITDA. So, you arrived at 8.03 as the EBITDA, original EBITDA of T Limited. You apply this 8.03 on revised EBITDA, which is 516. So, you get 4,100 as revised enterprise value. From that, you subtract debt of 820. How do you get 820? Here only we saw, no? 580 plus 240. From that, you subtract 820, you will get 3329. Now, this 3329 is what? Post-acquisition market capitalization. This market capitalization you have to divide by number of shares. What is the number of shares? We already arrived 14.59. Where did we arrive? We arrived at here itself. So, divide by 14.59, you get a price of 228. So, in this question, no, you cannot straight away make an assumption. See, already there are two assumptions. One is exchange ratio, one is EBITDA multiple, right? Now, even under post EBITDA multiple based acquisition, the revised price can be again computed using EBITDA multiple, implied old EBITDA multiple, and applying the same EBITDA multiple on the new EBITDA, or using old PE ratio, applying the same on the new earnings. Right? We have done both the methods. This is what is very, very important in this case. Right? This is the first part. Now we have finished the first part. Now coming to the second part. E Limited, their share count is what? 6 lakhs. We already know. First, T Limited is 12 lakhs and these fellows are 6 lakhs. They wanted what? They wanted, for every 2 shares in E, they want 1. So, for the 6 lakh shares, they wanted 3 lakh shares. Right? And they did not say whether it is payable by cash or shares. We assume it is by shares because everywhere else shares is the way of discharge. So, this 3 shares issued at 220, which is the current market price of share of T Limited, you make a total consideration of 660 lakhs. Now, is that a question that they have asked? Net consideration, yes. You have to tell what is the net consideration payable, 660 lakhs. Number of shares issued, 3 lakhs, we already got. EPS of T after acquisition. What is the EPS of T after acquisition? You have PAT. Originally, we've computed PAT. No, where is the post acquisition PAT? Here, 300. To this 300, you divide by 15, which is the post acquisition share count, because you have original was 12 and you've added 3, so both together 15. So 300 by 15 is equal to 20. Post acquisition EPS is 20, and on that PE multiple is 11. Okay, on that PE multiple is 11, so the price is 220. So in this scenario, there is no change. Now at this point, can we again apply EBITDA multiple? See, here also you can apply EBITDA multiple. There is now no harm. What will happen if you apply EBITDA multiple here? You've got here total consideration of 660. You've got total PAT and all of that. So what is EBITDA? EBITDA we already computed here, 516. So 516.57 into 8.03, right? That is what was the, minus debt of 580. You will get the same value. Minus debt of 820. You will get the same value, 3329. This 3329, but you have 15 lakh shares. So 3329.47 divided by 15 lakhs. So you will get 221.96. So you will get a value per share of, instead of 220, you will get 221.96. So this is another way to do. Even though I have not solved using the EV by EBITDA method in the second option, that is also another way. Now what is the other thing that they asked? Expected market price of T, state briefly advantages to T from the acquisition. So what are the advantages to T from this particular acquisition? In this particular acquisition, T Limited, by issuing shares, can reduce cash outflow. So in overall price of the share can go up. In one case it was 228, in one case it was 226, in one case it is 220, and I also found out 221. Out of 3 out of 4 scenarios, the price is going up. Whichever way you compute. Now market is going to use the EV EBITDA multiple, or market is going to use PE multiple, we don't know. Whether the deal will happen by issue of own shares at the rate of, when you value the company at EV by EBITDA multiple of 7, or you value the company at the rate of, a half share for every share held. So it depends on different scenarios, but the advantages in 3 out of the 4 scenarios, the price is going up. And the company looks like a smaller company, and easily, it can be integrated and acquired. If it's a fairly significantly large company, it becomes difficult. Okay, fairly interesting question, right? I somehow like this question, which is why I wanted to do this. Okay, now we have finished question number 25. Let us move to the next question. Next question is 31. BA Limited and DA Limited. BA Limited and DA Limited, both the companies operate in the same industry. The financial statements of both companies are given below. Current assets 14 lakhs, 10 lakhs, total 24 lakhs. Then you have equity capital 10 lakhs, retained earnings 2 lakhs, debt is 5 lakhs, current liability 7 lakhs, total 24. Same way data is given. Now for DA there is no retained earnings, only equity capital. Then income statement is also given. Sales 34 lakhs, COGS 27 lakhs, gross profit, operating expense, interest, EBIT. So probably this operating expense includes depreciation. Okay, then taxes, PAT, then number of equity shares, dividend payment ratio, and market price. So these are also given. Now assume that both companies are in the process of negotiating a merger through an exchange of equity shares. You have been asked to assist in establishing equitable exchange terms and are required to decompose share price of both the companies into EPS and PE components. Also segregate their EPS into return on equity and book value, intrinsic value per share component. Estimate future EPS growth rate based on operating synergies. You estimate intrinsic value would be 20 per share on acquisition. Required to develop a range of justifiable equity share ratios that can be offered to the shareholders of DA. Based on your analysis, where would you expect negotiated terms to be closer to, upper or lower exchange limits? This is a long one. So they want 20 rupees. You give a range. Where do you think eventual transaction will happen? Calculate the post-merger EPS based on exchange of 0.4:1 being offered by BA and indicate the immediate EPS accretion or dilution. And based on 0.4:1 exchange ratio, assume the pre-merger PE will continue after the merger. Estimate the post-merger market price. Also show the resulting accretion or dilution in pre-merger market prices. So based on 0.4:1, which is the exchange rate they have, find out the price and also show dilution, EPS accretion or dilution in the pre-merger market price. Fairly lengthy question if you honestly ask me, right? Because there is a lot of working to be done. So what are the first particulars that they have given in this kind of question? No? First thing, decompose the share price of both the companies into EPS and PE. Let us first do that. Let us do the simplest task. Do we have PAT? They have earnings after taxes 2,10,000, 99,000. So 2,10,000, 99,000. What is the share count? Share count is given here. Equity share capital 10 rupees each, 10 lakhs and 8 lakhs. So this has 1 lakh shares, that has 80,000 shares. So 1 lakh and 80,000. So you divide by the 2,10,000 by 1 lakh, you get 2.1 is the EPS. Why? Because 2,10,000 is the PAT, divide by the share count, you get EPS. In this case 2.1, here it is 1.24, 99,000 by 80,000. What is the market price per share? Have they given? Yes, they have given 40 and 15. 40 and 15. So what is the PE ratio? 40 divided by 2.1, which is 19.5, and 15 divided by 1.24, which is 12.12. So we've got till PE ratio and we've got the EPS. This is one thing. Then what else have they asked? Decompose share price of both companies into EPS and PE. Done. Also segregate EPS figures into ROE and book value. So we need to first get the book value per share components. Now, what is book value? Book value is net assets. What are the net assets? Your total asset. Either it is equity minus all intangible assets or total assets minus debt. You can do either way. So total assets minus debt and current liabilities is one way, or you can directly take equity capital plus retained earnings, which is 12 lakhs, 12 lakhs and 8 lakhs. You get 12 lakhs and 8 lakhs. You can take either way, it doesn't matter, you get the same answer. Now, what is book value per share? This 12 lakhs divided by 1 lakhs, which is 12. This 8 lakhs divided by 80,000, which is again 10. Book value is given. Now, they are asking what is the ROE? ROE means, what is ROE formula? Numerator is the return, which is the PAT. Denominator is the book value, which is return on, which is the basically the net asset value or book value, or value per share or book value per share. So book value we got as 12, numerator is 2.1, which is the PAT or EPS. So when you are doing it per share, you do EPS by book value per share. If you are doing overall basis, you take overall PAT divided by the net asset value. So here we do 2.1 by 12, you get 17.5, 1.24 by 10, you get 12.4%. Okay, so you've got return on equity, book value, EPS into PE is equal to market price. This part is done. Estimate future EPS growth rate. What is future EPS growth rate? Future EPS growth rate is G. G is BR. B is retention ratio into ROE. ROE we have just computed. What is retention ratio? Here they have said dividend payment ratio. So if payment is 40%, retention is 60%. Second case, payment is 60%, retention is 40%. So retention ratios are 60 and 40. Payout is 40, so retention is 60. So 60 and 40. ROE is 17%, 12.4. Just now computed. Multiply both, you get 10.5 and 4.95. These are the sustainable future growth rates. Then, based on expected synergies, the intrinsic value of DS equity share will be 20 per share. Okay, did we compute the value? We computed its value as market price as 15 was already given. Book value is 10, that is also there. They are thinking it will be 20. Who is thinking? The acquirer is thinking it is going to be 20. Even though what? Even though the market price is 15, they are thinking they can acquire it at 20. You are required to develop a range of justifiable equity share exchange ratios that can be offered by BA to shareholders of DA. Based on analysis, what would you expect the negotiated terms to be closer to upper or lower range? Now, what are the various ratios? You can do book value. I discussed this. In the initial part itself, I explained. First is book value basis, market value basis, then intrinsic value basis, then what else? Is there any other way in which you will compute? Some intrinsic value again can be DCF, you can do some PE method, or you can do some EV by EBITDA method, all of that. Here they have not given any of those. Okay, so we will see what we will do. Book values we have already found out, market value we have already found out, and intrinsic value is what you have to find. What do you mean by intrinsic value in this case? See, in this case, what should strike you is the G value is given. If G is given, you can do DCF. What do you do? What is garden growth model? Right, D1 by KE minus G. You can do actually DCF and figure out. Have they given what is the dividend? No, they have given dividend payment ratio. No? So you take the EPS, apply the dividend payment ratio, apply the growth rate, divide by KE minus G. But do you have KE? No, we don't have KE. So then how would you do it? Would you ignore this part? So you can't compute intrinsic value. So what are the other ratio that is left? Then you have EPS ratios. So you can do EPS, book value, market value, intrinsic value, not possible. Okay. What are the book values? Book values are given. We just now found out 12 and 10. EPS, that also we found out to 2.1, 1.24. What is current market price? That is also available 40:15. Then you have something called as intrinsic value, what I was just saying. Now, we think for DA, BA thinks for DA, that is acquirer is thinking target's intrinsic value is 20. So, that is not a problem. But what is acquirer's intrinsic value? We just now realized that we couldn't compute it based on divided by K minus G because we don't know the K value. Can the acquirer think that its market price is a valid number? Yes, that is 100% possible. Why? Because they are issuing, it's a share swap, so they are issuing their own shares, so they think that it is a fair value, or at least the value will be higher than this. Okay, value, if they can assume their intrinsic value to be higher than this, but definitely not lower than this. So, this is one more thing that you can assume, and you have to make an assumption, which is what intrinsic value is considered at current market price. Why can't you consider it at book value? I'll tell you the reason also. You can't consider it at book value of 12 because other company has book value of 10 and you are thinking its value is 20. Other company market price is 15, you are thinking it is 20. So, at minimum your intrinsic value should be at least 40, which is the market price, or more. It cannot be less than that, right? So, what is the ratio? And I told you also in the working, just simply 40 by 20, 40 by 15, 12 by 2, like that you do. Okay. So, when you do, you get 0.5, which is 0.5 means my BA value is twice that of DA. So, for every share of DA, I will give only 0.5 shares. So, for one for every 2 shares. For 1 share of yours, I will give 0.5, or for 2 shares of yours, I will give 1. That is 1 for every 2 shares. The second one is what? You got a ratio of 2.67. So, I will give you 1 share for every 2.67. Then I will give you 1 share for every 1.2. I will give you 1 share for every 1.69. Okay. You have to state either this way or this way, but you have to state something very, very clearly. Now, number of shares the acquirer will be given. They said, what is the range? What is the range? The range here is, you will for every 2 shares, 2.67 shares, or 1.2 shares, or 1.69. So, what is the lowest value here? 1.2. What is the highest value? 2.67. So, it is between 0.833 or 0.375. That is, for each share of yours, I will give either 0.37 or 0.833, somewhere in between. Now, where will the transaction held? 0.833 is at 12:10. 0.375 is 40:15. So, for where is it likely to conclude? Upper range or lower range? So, which one will you consider? You put 0.833 for every 1 share of yours, I will give 0.833 or I will give 0.375. Which one I will prefer giving? I will prefer giving 0.375. What is this very, very specific question they asked? Would you expect negotiation closer to the upper range or lower range, and why? So, you will say key metrics of growth, EPS are better in case of acquirer. Correct? We just now found out. The exchange ratio will be in favor, so fewer number of shares of the acquirer will be issued per target. So, negotiated terms will be closer to lower part of the exchange ratio. So, they will be more closer to 0.375 than 0.833. Then, what did they say? Calculate post-merger EPS and exchange ratio of 0.4:1. So, they have changed the story. Here 0.4:1 is what? If you give 1 share of yours, the target's 1 share is equal to 0.4 shares of the acquirer. Okay, being offered by BA Limited, and calculate the immediate EPS accretion or dilution that will occur to the group. So, if I am issuing 0.4 shares for every share that you hold, you have how many shares? 80,000. So, for this 80,000, I will issue 0.4. 80,000 into 0.4 is 32,000. Right. So, original share count 1 lakh plus 32, 1 lakh 32. What is the original PAT? You have 2 lakh 10 plus 99, which is 309. 309 by 132 is 2.34. 2.34 is a revised EPS. Now, what is pre-merger EPS? 2.1. It has increased to what? 2.34. That is an increase of 0.24. What is the increase percentage? 11%. So, increase in EPS of the acquirer is 11% EPS based on exchange ratio of so and so being offered by BA. So, you have computed post-merger increase in EPS. Now, do you have to compute it for target also? Yes. They have not said it explicitly, so you have to do for both. What is pre-merger PAT? Pre-merger share count is 80,000. Post-merger share count of DA is 32,000. Why 30,000? Because you have allotted 32,000 shares. Now, equivalent shares is 0.4. That also we found out. So, post-merger EPS is 2.34. So, what is the equivalent EPS? 2.34 into 0.4, that is 0.93. What was your original EPS? 1.24. We had this 1.24 here, no? 1.24. Originally it was 1.24, but post merger you have lesser number of shares. So equivalent EPS for you for every share that you held in original company is 0.93. So from 1.24 it is fallen to 0.93, a reduction of 24%. So for the target, EPS reduction is 24%, for the acquirer, EPS increase is 11%. This is called accretion, this is called dilution. Okay, then what is the fifth point? Based on same ratio, assuming pre-merger PE will continue after the merger, estimate post-merger market price, also showing you the resulting accretion. Post-merger market price for whom? For the remaining entity, but can we compute for equivalent shares? That also we will see. So PE ratio is going to remain the same. What is the original PE ratio? We computed here, 19.05. So this 19.05 will apply on revised EPS. What is revised EPS? 2.34. So you take 2.34 into 19.05, you will get 44. 44 is going to be the post-merger market price. What was the pre-merger market price? 40. What is the increase? 4.59, which is again 11%. Okay. For the acquirer, this is okay. What about the target? Pre-merger market price was 15. But post-merger market price is how much? 44.59. But 44.59 is for one share. But for every share you got only 0.4 of 44.59. So you got 0.4 into 44.49, which is 17.84. So for you, original price was 15, it has gone to 17.84. So the increase is 2.84. So for you, in the terms of the price, it has increased to 18.90. Why has this increased to 18.90? Because pre-merger PE was 19 and you had old pre-merger PE for the target was 12. So the target is getting shares which are valued at a higher multiple of EPS. So higher multiple of EPS, that is higher PE ratio applied on the EPS. So the value of the share that is allotted to the target is much higher. Even though you got lower number or fewer number of shares for each of your shares, the effect is offset. I got lower number of shares here, but the price of the share that I got is very high. So they both are offsetting, and the target's shareholders are also making money. How much money? On a per share basis, they are making 18.90%. Okay, very interesting question, right? I genuinely love this question because it is very structured. Again, very structured, smooth flow. You write the format, write the key points, and automatically you'll be able to get the answer. Okay, fair enough. Let us move to the next question. What is the next question? Question number 32. Next is this question on weak bank, strong bank. Okay, before we go to this question, I want to show you something. I said no. In the last point number 20 and 21, we'll discuss this later, especially restructuring of companies and all that. And even with respect to banks, please remember these points. Capital reserves in post-merger balance sheet is balancing figure, and this is arrived at as book value of shares of the target minus face value of shares in the acquirer. Please remember this concept. What is the book value of shares of the target? Whatever is the net assets of the target, minus what is the share that you have issued, that is face value of the shares that you have issued to them. Okay. The difference between those two is the capital reserve. Okay, it is going to be the balancing figure in the balance sheet. Now let us come back to the question. During the audit of weak bank, RBI suggested the bank should either merge with another bank or close down. Okay, so strong bank submitted a proposal for merger of weak bank with itself. The irrelevant information of both the companies are as under. So weak bank gross NPA is 40%. My God. Capital adequacy is 5%, market price is 12, book value, where is this? Trading on stock exchange, irregular and frequent. Book value they have not given, we are supposed to compute. Okay, book value has some weight, assigned weight, they have given some percentage of 10%. We'll see what it is. Paid up share capital 150, reserves 80, deposits 4,000, other liabilities 890, total liabilities 5120. Cash in hand, bank balance with other banks, investments, advances, other assets, preliminary expenses need to be written off, 5120. So the weak bank has balance sheet total of 5120, and strong bank has 52,500. Strong bank doesn't have any preliminary expenses, and its ratios are also good. You are required to calculate swap ratio based on the above weights. What are they referring to as weights? Here they have given weights. Based on these ratios, that is 40:5, 5:16, 12:96, you are supposed to arrive at a ratio. Okay, we will see what that ratio is. You are also supposed to compute a book value that also has a 10% weight. So that computation becomes very important. Now, then ascertain number of shares to be issued. Once you figure out what is swap ratio, shares issued is simpler. Prepare balance sheet after merger. Yes, you prepare. Calculate CAR and gross NPA, we will compute. Now, what is first thing that you have to do? You have to compute the book value. Without that, you can't compute the weighted average swap ratio. Paid up capital is how much? 500 plus 5,500, 6,000. No, nothing else. So you can take 6,000 here. And 150 plus 80 is 230. 230 minus 50, right, is 180. So 6,000 and 180. You can do it from asset side or liability side. Okay, no, doesn't matter. What is per share, number of shares? 10 rupees the face value. So you divide by 6,000 by 10. So you divide the paid up capital by 10, paid up capital of 150 by 10, you get the share count, which is 50. And here you will get 15. So what is the book value? Total net asset value or total value of equity plus reserves and surplus, equity share capital plus reserves and surplus, divided by the number of shares. Share count we got as 50 and 15. So you divide 6,000 by 15 and 180 by 15. 6,000 by 50 and 180 by 15, you get 120 and 12. Very, very apparent that 120, the strong bank is genuinely strong. Now, here there is one small twist. See, gross NPA. NPA higher number is good or lower number is good? Lower number is good. But book value, higher number is good or lower number is good? Higher number is good. So, you have to be very careful. See here, I don't know if how many of you noticed. This is 40:5, this is 5:16. This is 12:96. See, strong bank having a 96 market price is okay. Strong bank having capital adequacy 16 is okay. Strong bank having 5 as gross NPA is also okay. But when you look at it as 40:5 and then same next breath you take 5:16, this is not correct. When you are looking at this ratio, it has to be inverted or these ratios have to be inverted. One of those things have to happen. And anyway, we have found out the book value also. I think 120 something, right? 120 and 12. So you put book value, this is strong, this is weak, right? So what did you do here? 5 by 40, this strong by weak. You got 5 by 40 is 0.125. But when it came to car, what did you do? Strong has 16, weak has 5. You didn't do 16 by 5, you do 5 by 16. I said one of them has to be ulta. Either these three have to be ulta or this has to be ulta. Here we chose one method, we will follow that. Either ways you will get the same answer, don't worry. So here also 96 and 12, so 12 by 96, 0.125. Now what does this 0.125 mean? It means that for one share of weak bank, I will give 0.125 shares of strong bank. Here also for one share of weak bank, because your gross NPA is 5 and mine is your gross NPA, that is the target's gross NPA is 40 and the acquirer's gross NPA is 5, the ratio is 8 times. So for one share of the target, I will give 0.125 shares of the acquirer, or for 8 shares of the target, I will give 1 share of the acquirer. So which is why this ratio, this is very, very, very important thing in this particular topic. Just don't apply common logic. 5 by 40, 16 by 5, 96 by 12, 120 by 10, gone. Whole question is gone. Please don't make that mistake. This is one very, very important aspect. Then you apply the weights. So you directly multiply 0.25 into 30, this into 28, this into 32, this into 10. How would we get this as 0.1, 120 and 12? We just computed the book value. Now you got all the averages. Take all of them, 0.175. Now what is this 0.175? For one share of weak bank, I will give 0.175 shares of strong bank. This is the point you have to remember. Whenever you arrive at a ratio like this, if you are confused in your mind, is this that for this for that, you just think calmly. Here the names are also very simple. The target is going to get fewer shares. So for one share of target, they are going to get fewer shares of acquirer. So 0.175 is that. This will get complicated, especially when ratios are contradicting. Book value is, let us say, I'll give you a rough example, okay. Book value, this is acquirer target. Let's say book value is 40, target is 100. Market price, and this usually doesn't happen, okay. This is 400 and this is 50. Can this happen? Theoretically, yes. Practically, no. But if they give a question in this, see what happens. What is the ratio? Here this is 1:2.5. Here it is 8:1. Okay. So how will you apply the ratio? You will suddenly get confused. Which one should you apply? So in that particular scenario, just simply multiply 1:2.5. 1:2.5. 1 by 2.5 is 0.4. Then do the same thing here. How did you get 0.4? 40 by 100 is 0.4. 400 by 50, you get 8. You just go by this logic, continuously go by this logic and see, if I am getting 0.4, how many shares of target for shares of acquirer? Here acquirer is low valued, so for 1 share of acquirer, the 0.4 shares of target are given. Whereas here it is ulta, for 1 share of acquirer, 8 shares of target are given. Right. So, you may have contradictory ratios, be very, very careful. Again, you apply the same logic. What am I doing? You please think through, you will be able to get an answer. When I say what am I doing, you are writing the exam. No, not that. In this scenario, how many shares of whom are given to whom? In this scenario, how many are given to whom? Same logic I will apply to the weighted average. That's all. Okay. Then, 1 share of weak bank for 0.175 strong. This also we have done. Calculate swap ratio. Ascertain number of shares to be issued. This is very simple. No, how many shares are there? You have share capital also we computed here. Paid up capital is 150. Share face value is 10. So 15 lakhs. So for 15 lakhs into 0.175. 15 into 0.175. This is 2.625. That's all. Very, very simple. 2.625. And what is the specific question? Ascertain number of shares, 2.625 over. Prepare balance sheet after merger. For balance sheet after merger, you need the share capital. So into 10, 2.625 into 10 is 26.25 is the share capital. Now in balance sheet, what is the point that I showed you? The balancing figure is the capital reserve, which is also arrived at as the difference between book value of the target, book value, when I say book value per share of the target minus face value of the shares issued to the target shareholders. What is the face value? 26.25. What is the book value? Book value we have already computed here. Where is book value of, not per share, here this 26.25 is the book value of all shares together, basically equity. Here 26.25 is face value of all shares issued, okay. It's not per share. Per share face value is 10, but issued 2.625 lakh shares. What is the book value per share? Did we compute it somewhere? Yes, we had computed it somewhere. Weak bank is 12, and that also we did. What is the total net worth? We said 180. So 180 is the value of equity plus reserve and surplus, that is equity share capital plus reserve and surplus of weak bank. Whereas 26.25 is the replacement of that. So I am taking away 180, giving you 26.25. So net difference between those two, 153.75 should be your capital reserve. Let us see if that is correct or not. So equity share capital 500 original. Where did I get 500 from? Strong bank, original 500 plus 26.25. What you issued, you get 526.25. Then cash, you add both. Balance with other bank, you add both. This is not inventory, this is investments. You add both, you get some value. Advances, you add both. Other assets, you add both. What happened to preliminary expenses? There was something called preliminary expenses, no? Arey Baba, where is this preliminary expenses? What happened to this preliminary expenses? When you computed the book value, you wrote it off. So that need not be considered again. You tell me in all the CA inter working or even FR, whatever you have done of amalgamation, you have obviously adjusted for these preliminary expenses. Right? If you have not done, please note in AFM you adjusted. As far as I know, you adjusted in FR also. Okay, so that is one. Then coming to the other side, deposits you add both, other liabilities you add both, and reserves and surplus. Original reserves is 5,500 and reserves is 153. What was the number I told you? 153.75. How did I get it? Original book value of the business that is acquired, book value of the equity or net worth or equity plus reserves and surplus, equity share capital reserves and surplus, that minus the face value of shares issued, which is 26.25. Difference between those two is capital reserve. So 153.75 is a capital reserve. You add that to its own reserves of 5,500, you get the total. Everything will match on both sides. It is also the balancing figure. It is also arrived at as difference between those two. So how did we do? 180 minus 26.25 is 153.75. That's all. Now, what is the other point that they asked? They said, after doing all of this, compute the capital adequacy ratio and gross NPA. What is capital adequacy ratio? They themselves have given, boss. Your capital adequacy ratio is total capital by risk-weighted assets. Now, will capital be more or assets be more? Capital, and is it percentage, non-percentage? Actually is a percentage. So, this is 5%, this is 16%. Your capital, that is equity share capital plus reserve and surplus, will be lesser than all your assets put together. What are your assets? Loans that you have given. See, a bank is a factory of credit. If bank has 10 rupees, it will lend 100 rupees. Why? Because of the CRR, because of the deposits and all of that. I hope you remember all of that. So, for the strong bank, its equity capital plus reserves and surplus represents 16% of its risk-weighted assets. So, what you do is, 16% is the car. Capital equity share capital reserve surplus is 6,000. So 6,000, 16% is equal to 6,000 by risk weighted assets. So risk weighted asset is equal to 6,000 by 16%, which is 37,500. Same way you do 5% and 180, you get 3,600. Now what is a combined risk weighted asset is summation of these two risk weighted assets, which is 41,100. Now what is a combined CAR? Combined CAR is combined equity capital, which is, what do we have? 500 plus 26.25 plus 5653. So you have 526.25 plus 5653.75. So you have 6180. 6180 is the combined equity. So 6180 divided by 41,100, you get 15%. So original guy had 16%, weaker guy had 5%, both got merged, it came down to 15%. Even then it is still a decent number. Then revised gross non-performing asset. What is non-performing asset? Same way, non-performing asset as a percentage of total advances. So 5% is NPA, gross NPA, 40% and 5%. Now these are the values. Now what is the total advances? Have they told you what is the total advances? Yes, they have given here. 35,000 and 2,000, 3,500 and 2,700. So 5% of 27,000 and 40% of 3,500. Those are the numbers. 5% of 27,000, 40% of 3,500, you add up, you basically get gross NPA of 1,400 and 1,350, total of 2,750. What is the, now on overall basis, what is the gross non-performing asset? 2,750 by 3,500, which is 9%. So from 40, and this fellow had 5, this fellow had 40, it came down and settled at 9.02 because of the merger. Okay, so you have to remember these terms. What are capital adequacy ratio? What is numerator? What is denominator? If they give in the exam, very good. If they don't, you have to figure it out. What is NPA? Non-performing assets as a percentage of total assets. That is, assets are what you have lent. That is, all your advances are assets. Right. So your non-NPA divided by your advances. This, if you forget, gone. This question is gone. You will do everything, but you are confused. What to do, where to do, how to do. Okay. Please don't be in that scenario or position anytime. Okay. Let us move to the next question. Mrs. Tiger Limited wanted to acquire Leopard. Very nice names they choose. The balance sheet of Leopard as on 31st March is as follows. Equity share capital, this is of the Leopard only, okay. 70,000 shares of 10 rupees is 7 lakhs, retained earning 3 lakhs, debentures of 12% 3 lakhs, creditors and other liabilities 3.2 lakhs, cash 50k, data 70k, inventories 2 lakhs, plant and equipment 13 lakhs. Okay. Now, shareholders of Leopard will get 1 share in Tiger for every 2 shares. That is, you have 2, I will give you only 1. External liabilities are expected to be settled at 5 lakhs. What are external liabilities? This 3,20,000 is going to be settled at 5 lakhs. Oh my God, okay. Shares of Tiger will be issued at its current price of 15. Okay. Debenture holders will get 13% convertible debenture in the purchasing company for the same amount. So instead of 12, you are going to get 13%. Why are they acquiring then? Debtors and inventories are expected to realize only 2 lakhs. 2,70,000 is going to come down to 2 lakhs, whereas this 3,20,000 is going to go up to 5 lakhs. What a weird external liabilities. What do you mean by external liabilities? Acha, okay. See, that is where I made a mistake. External liabilities here means this plus this together. This 6.2 is going to become 5. This 3 is going to remain same 3. Debentures will get 13% debenture in the purchasing company for the same amount. So, balance 2. So, this 3.2 will become 2 lakhs. So, okay, this is mix of some amount of restructuring and acquisition both put together. Tiger has decided to operate business of Leopard as a separate division. Okay. The division is likely to give cash flows to the extent of 5 lakh per year for 6 years. Okay. Tiger has planned that after 6 years, division would demerge and dispose of for 2 lakhs. For 2 lakhs. Okay. The company's cost of capital is 16%. Make a report for the board for company advising the financial feasibility of the acquisition. Net present value for 16% are as follows. Now, what are you asked to do? You are asked to make a report about the feasibility. For you to do the feasibility, you have to first figure out how many shares are going to be issued, right? And what is going to be the benefit per share? Is any share price relevant? So, how do you compute the feasibility of this? Whenever we talk of feasibility with respect to projects, you take NPV. What is NPV here? What are you going to realize when you sell? Or what are the in between cash flows minus what is the initial cash outflow? What is the initial cash outflow? Are we paying by cash? No, we are paying by shares. So we will take the price per share, the number of shares that are issued is your initial cash outflow, right? So what is the existing share? 70,000 shares. You are issuing half, right? So you are issuing 35,000 shares. 35 into 15, 5,25,000. 5,25,000 is the amount that you are paying to equity shareholders, right? And you are issuing also debentures. In order to take over that company, you are issuing debentures also. You are not only paying equity shareholders, you are paying debtors also. So debentures, you are also paying creditors, that is creditors to the company, creditors to the target. So 3 lakhs of debentures, and external liabilities paid 5 lakhs. So see, the assumption here is whether when they say external liabilities, it's a very poorly worded thing. External liabilities are expected to be settled at 5 lakhs. Does it mean only this is 2 lakhs? Both put together is 5 lakhs, or only creditors and other liabilities is 5 lakhs? This is a fairly unfair way of asking. So here I have taken an assumption that this external liabilities refers to only creditors and other liabilities, right? Then how much money did you realize from this? You got cash of 50k, debtors and inventory you got it for 2 lakhs. So totally you have paid for what? Paid for buying the plant and machinery. You have paid 5,25,000 plus 3 lakhs plus 5 lakhs minus 2 lakh 50, right? Which is 13 lakh 25 minus 12 lakh 2 lakh 50, which is 10 lakh 75. So you've got paid off 10 lakh 75 in form of issuance of equity shares, repayment of debentures and all of that, and got plant and machinery. Okay, the value of that is 10.75 lakh. Now what is the plant and machinery generating money for you? The 10.75 lakhs is generating how much? They said it is going to generate after tax 5 lakhs for 6 years, and finally dispose it off at 2 lakhs. So 5 lakh for 6 years at what percent? 16%. They gave some present value factor. You add all of this. Okay, you get a 3.684. So you get 18 lakhs here, and terminal value is 2 lakhs. Last year 2 lakhs may use dispose of at terminal value of 0.4 and you get 82. So totally you make money of 19 lakh 24,000. So you paid how much? You paid 10 lakh 75 to get an asset of plant and machinery which is generating revenue for you or income for you or PAT, which is generating after tax profits for you of 19 lakh 24. So 8 lakh 49 is the overall profit you are going to make from this deal, and hence the NPV is positive and hence acquisition is feasible. But only one thing note, my dear friends, this 5 lakhs is not a fair ask, which is what 5 lakhs is external liability. Why will you settle creditors for higher than what they are? Do we have any contingent liability? They are not mentioned that. So you can take an alternative assumption that you are settling this 3 lakh 20 at 2 lakhs only. Then what will happen? Then external liabilities, instead of 5 lakhs, it will become 2 lakhs. If you are paying off the external liabilities of only 2 lakhs, why 2 lakhs? Total external liabilities 5, out of which 3 is debenture, so balance is 2. So if you pay off 2, what does this become? 5.25 plus 5, which is 10.25 minus 2.5, which is 10.25 minus 2.5 is 7.75, which is exactly the 10.75 minus 3 lakhs. So against this 7.75, you are going to generate 19.24. So that way also, if you solve, ideally they should give marks. Please state an assumption. What do you mean by external liabilities? Okay, very unfair way, but nevertheless, we will proceed with this. Then let us move to the next question. This is illustration 34. B Limited wants to acquire S and has offered a swap ratio of 2:3, 2 shares for every 3 shares of S. They have been very specific, good for us. And this is a May 22 RTP question. Following information is available. PAT 2,10,000, 4.5 lakhs. Equity shares outstanding 6 lakhs, 1.8 lakhs. CPS 3.5, 2.5. P ratio 10 times, 7 times. Price quoting on per share on BSE before the merger 35, 17.5. Very clearly, B Limited has a better price, better PE, overall bigger profits, bigger size. The number of equity shares to be issued by B Limited for acquisition of S Limited. On what basis? On this 2:3 basis. Very simple. So if for every 3 you will issue 2. So 1,80,000 by 3 into 2, which is 1,20,000. So very clear, 1,20,000 over. What is the EPS of B after acquisition? 1,20,000 old shares, 6 lakh new 1,20,000 new shares, 6 lakh old shares. Combined profit is 25.5. This is 1,20,000. Then 25.5 divided by 7.2 lakhs. You get 3.5417. Done. Determine equivalent earnings of S and calculate per share gain or loss to shareholders of S. Now, equivalent earnings. When they said equivalent earnings and followed it per share gain or loss, they are referring to EPS. Okay. So, what is equivalent earning? Post-merger EPS we computed here as 3.54. right? How do you get 3.54? Post-merger PAT of 25.5 divided by the total share count 7.2, you get 3.514. This 3.74 is for one share, but for every 3 you got only 2. That is, your EPS is lower than this. So divide by 3 into 2, you will get 2.36. 2.36 is the EPS for equivalent share of the target. And what is the original EPS of the target? 2.5. So the reduction or impact is 0.13. Okay, you can give it in percentage terms also, doesn't matter. Then what is the expected market price of B after acquisition, assuming it PE multiple remains unchanged? So what is PE multiple? 10. 10 into 3.54. So you will get 35.47. Very simple, super simple. Then determine market value of merged firm. What is the market value? You are assuming the same PE continues, 35.41, right, 47 into total number of shares, which is 7,20,000, which is 255 lakhs, which is 255 lakhs. This is also super simple. Then after announcement of merger, price of shares of S Limited rose by 10%. Mr. X, on investor having 10,000 shares of S is having another investment opportunity which yields an annual return of 14%, is seeking advice whether it needs to offload the share in the market or accept the shares from B. So if the shares are going up by 10%, if I sell it off, how much money will I get? See, currently it is priced at what? EPS is 2.5, PE ratio is 7. So 7 into 2.5 is how much? 7 into 2.5 is 17. Okay. This 17 has gone up by 10%. That is, it has gone up by another 1.75, which is basically 19.25. Should I sell it off at 19.25? Okay, get the money, invest it at 14%, or should I hold on and will I get better value? Why will I get better value? Let us see. 19.25. What is the equivalent EPS? We just now found out. Equivalent EPS is 2.36. On this 2.36, we apply the multiple of 10 by the new, on this we multiply the multiple of PE multiple of the acquirer of 10. So you get 23.61. Why have I done like this? Because if you take 35.471 is the price of the share, that is the value of full share, but for every 3 you got 2. So you got only 2/3 of this value, which is same as 23.61. Instead of multiplying the share price with the equalization value, I multiplied directly the equalized EPS with the PE, right? So I have got a price per share of 23.61. Now what do I do with this 23.61? From current level, which is 19.25, it can go up to 23.61. So potential upside left is 22%. It can go up by further 22%. Why? Because if the same EPS, if the same PE is applicable, that is pre-merger PE of the acquirer is applicable on the post-merger EPS, for my post-merger equivalent EPS, I will get a value which is 23 rupees. Whereas my alternative, that is when the market has gone up by 10%, I get only 19%. So I will get 22.65, which is the upside, that is left. Or you can also see it the other way, which is 35 what I told you into 23, you get 23.61 by 19.25, again you get 22.65. So there is a further upside of 22 which is higher than alternative of 14. So you can invest at 14, but I am telling you there is 22% upside here itself. So please continue to hold. Okay. Then another way to look at it, completely different way to look at it. Earnings yield. What is earnings yield? EPS by current market price. What is EPS? 23 divided by 19, which is 12%. But opportunity cost is 14%. Earnings yield is lower. So if you look at it from a market price, this is the scenario. If you do it from an earnings yield, this is, earnings yield is lower. But please remember, friends, as far as I know, in the entire markets, everything is focused on the price. EPS reduction increase will also impact the price. Please focus on the price, not on the EPS. As far as ICA is concerned, the focus is a lot more on EPS, and hence I have shown this method. But see, have they said which method? They have not said use earnings yield or price. So I have given you both price as well as earnings yield. Give both if possible in exam. Okay, give both in possible in exam. ICA is a lot more focused on this earnings based increase or decrease rather than price based. Okay, but I am more focused on price based because that is what is the market. My suggestion, give both. If they don't specify, give both. Okay, everywhere in this chapter I have told multiple times, whenever they don't specify whether the exchange ratio is on what basis, whether the increment on whether shareholder has gained or lost, always compute both the price basis as well as EPS basis. And here, because there is no direct EPS thing, you have to compute EPS yield or earnings yield basis. Okay, okay, both of them contradictory answer. That is another point to note here. Okay, let us move to the next question. So friend, now let's move to illustration 36. This is a December 21 old syllabus question. X Limited proposes to acquire Y Limited. The relevant financial details of two firms prior to the merger announcement. Okay, are as follows: market price, number of shares outstanding. Based on this, what can we get? Market price into number of shares. You can get market cap. The merger is expected to generate gains with a present value of 120 lakhs. What is 120 lakhs? Synergy. XYZ will issue one share of it for two shares of Y. So XYZ is more valuable than X will issue one share of X Limited will issue one share of it for two shares of Y. So X is more valuable than Y. You are required to find out the true cost of the merger. True cost. What did we discuss as true cost? Let us say what is true cost of the merger. We will first figure out. Current market price is 80 and 40, and as I said, the first thing that you are supposed to do is when you have 10 lakh shares and 5 lakh shares, you have to find out the market cap. Market cap is 800 and 200. Good. So combined is 1000 if at all that continues. Then present value of futures energy benefits is 120. So the market cap will increase by 120. So 1000 plus 120, 1120. Now what are the shares that are issued? For every 2 shares, 1 share. So how many shares are there? 5 lakh shares are there. So 5 by 2 into 1, you will get issue 2.5 lakh shares. So you issue 2.5 lakh shares. Who will issue? X will issue to shareholders of Y. So now if you issue 2.5 lakh shares, original shares is how much? 10 lakhs. 10 plus 2.5 is 12.5. And these shares are traded at what value? They are traded at a price of 80. Okay. So on the current market value, 2.5 into 80 is 200. You have issued 200 crores worth of 200 lakhs worth of shares to Y Limited. Okay, and what is the total share count? 12.5, and share price is 80. So market cap is 1000. You add 120 of synergy, you will get 1120. This 1120 is applicable, or is who owns this or who has access to this 1120? Entire 12.5 lakh. So you divide 12.5 lakhs, right? So this you basically try and apportion this 12.5 lakhs. How much is pertaining to which? X pertains to 10 X shareholders. Original X shareholders have 10, and 2.5 is for Y. That both makes it to 12.5. So basically this is 2.5 by 12.5. This is 20%. This is 80%, right? So 20% of the revised market cap. Revised market cap is how much? 1120 we just found out. So 20% of the revised market cap is what you have, is the benefit that the target has got, which is how much? 1120 into 20%, 224, right? Price paid minus shares issued to shareholders of Y. That is the true cost of merger. What is the shares that you have issued to the shareholders of Y, the target? Here we have computed the market value of the shares that you have issued is 200 worth, but the benefit that they have got, or rather the incremental value that they have got, is 4. Why? Because 224 is the market value that they have got because of including the synergy value, and the this is 24, not 4, okay, and 200 is the cost that you have paid. 200 is the equivalent value of market cap you have given them, but they have got 224 because the market cap has increased. So the cost of the merger from a acquirer perspective is the difference between these two, which is 24. So if you come back, if you recollect this point number 12, what I wrote here, what is true cost of merger? Post-merger market cap of target minus pre-merger market cap of target. This is the true cost of merger. Please do not forget this. Okay, it is another way to look at it is price pay, value received minus price paid. Okay, what is the value received by shareholders of the target? 224. What is the price that you have paid? 200. So what is the difference? 24, which is the true cost of the merger from the acquirer perspective. Okay, now this is illustration 36. After that, the next illustration we have in the list is 39, if I am not wrong. Correct, 39. ICL is proposing to take over SVL, and this is a question, by the way, from November 20. ICL is proposing to take over SVL with an objective to diversify. ICL's profit after tax PAT has grown at 18% per annum, and SVL's PAT has grown 15%. Both the companies paid dividend regularly. The summarized P&L is as follows. ICL net sales, PBIT, interest, then tax, then PBT. Tax, then PAT, and then dividends. What is the dividend you have declared? Then they have given fixed asset, land and building, machinery, current asset, current liabilities, creditors, overdraft, tax provision, dividend provision, net assets, so on and so forth. They have given the data. ICL's land and building are stated at current prices. SVL are revalued 3 years ago. There has been an increase of 30% in the year, per year in the value of land and buildings. There has been an increase of 30% per year in the value of land and buildings of SVL. So for every year 30% you have to compound it. SVL is expected to grow 18% each year after the merger. ICL wants to determine the premium of the shares of the current market price which can be paid on acquisition of SVL. You are required to determine the premium using net worth adjusted for the current value of land and buildings plus the estimated average profit after tax for the next 5 years. So please remember, we did a problem like this earlier also. Net worth adjusted for land and buildings plus next 5 years profit, or the dividend growth formula, and ICL will push forward which method during the course of negotiation. Out of these two, which is the most preferred? And then they have given period wise in 30%, 15%, what are the future value. What will you do with it? We will see. Okay, because for this 30% we need a future value only. Okay, first thing is we are supposed to find out for whom? For SVL. SVL, what are we supposed to find out? First, we are supposed to find out the net worth. How will you find out net worth? Net worth is basically your equity plus reserve and surplus plus any adjustment. What is the adjustment? Land and building value is adjusted. So let us see. Are there any unamortized preliminary expenses or anything like that? No. So you can actually directly take the value of paid up capital and reserves and surplus, which is this 1300 and 785, and directly adjust to that the increase in the value of land and building. Okay. So book value of assets is 890. Where did we get this? 890 here. Okay. Out of that, book value of land and building is only 190. Where is this 190? Here it is 190. This 190 has grown at 30% per year for last 3 years. So 190 into 1.3 is equal to 1, 2, 3. So you get this, you use this 2.197. So 190 into 1.3, you get 417, which is this 2.197 is the future value factor. What is the increase? 417 minus 190, 227. So your overall land and building has increased to 227, right? Now, one way to do it is directly take this 785 plus 227. You will get how much? 1002. Okay, this is one way. So 785 plus 227 makes it what? 785 plus 227 is 1012. 1012. Right, that is one way. Another way is you take this book value of assets, add this increase in value of land and building, subtract the borrowing, same thing, you will get 1012, you will get the same number. Okay. So this is the net worth. What is the way in which you are going to value? Net worth adjusted to current value of land and buildings plus estimated average PAT for next 5 years. What did they say is PAT story? PAT is going to grow at 15% per annum. Okay. In the past. In the future, what will happen? It is expected to grow at 18% per annum. Will you consider the 15% or will you consider the 18%? Which one will you consider? Which one is important? See, when you are acquiring based on some expectation. That way, you should consider future growth. But that future growth is happening because of you, not because of them. If you allow the target to continue, they will grow only at 15. Why should I give a share of my future synergy with them? So there are two logics, that is, should I share some synergy with them, should I not share the synergy with them. So if you take PAT was what? 250, right? PAT was 250. So this 250 for next 5 years, okay, it will grow either at 18% or it will grow at 15%. If it is at 15%, it is 7.753. So please see friends, here this 15% is cumulative value. Whereas here when you look at this 30%, it is non-cumulative. So if you want cumulative, why do you need cumulative here for 15%? Because you are trying to compute the all profits of next 5 years. First year plus second year plus third year plus fourth year. So that is why this 7.753 is the value. So please cross check when they give data like this, 7.753. So that's what one of the things I was wondering was, for 30% it is 3.7, for 15% how is it only 7.75? 15% should be lower, no? So actually what has happened is that 30% is the simple factor. That is, it is just the compounding, whereas the 15% is compounding plus sum of all the previous compoundings. Okay, so that is how you got 7.75. Same way, if you do for 18%, you will get a value of 8.4. Okay. Now, in this particular question, I have computed using both. The reason is they have not specified whether you should value this company based on future growth potential or past growth potential. So, 250 into 8.5 and 250 into 7.7. So, you will get 2,100 and 1938. So, if what is the average profit of this? What did they say? They said net worth plus average estimated profit after tax for the next 5 years. Average. So, you should do by 5. By 5 both of them, you get some 420 and 380. Okay. Adjusted net worth, which is 1012 what we arrived here, plus either 422 or 387. So, you will get 1434 or 1400. Now, this is the value. What is paid up share capital of these guys SVL? SVL paid up share capital is 125 crores of rupees 10 each. Everything is in crores, right? Yeah. That is 12.5 crores is the number of shares. So, 12.5 crores is the number of shares, and what is the value per share? Value per share here is based on these two numbers, 1434 and 1400 is 1434 by 12.5 is 114 and 1400 by 12.5 is 112. 114 versus 112. What is the market value? Market value is 75. Okay, this 75 is lower than both of them. Okay, now what is the second method is? Second method is dividend discount model. What is it? Current market price is 75. D0 is 125. Why is D0 125? How did I get D0 as 125? Here they have said provision for dividends is 50 and here they have said dividends as 125. Which one will you consider? Out of this 125, which is the full year dividend, some might have already been paid. This is only the balance. So, never consider balance sheet item for dividends, but that may be only the final dividend. Always consider the P&L item which shows for the year how much dividend is been paid. So, 125 CR. 125 CR means for how many shares? 12.5. So, per share it is 10 rupees. Right. So, 10 rupees. And what is the growth rate? Growth rate, it is 15% based on existing setup. You will use current data of 75 is equal to, so see what is this? P0 is equal to D1 by KE minus G. Correct. So, what you do is, because you have P0 of 75, you know D1, next year's D1 of 11.5, you don't know KE, you know G of 15, you use this and work backwards. That is D1 by P plus G is equal to KE. So, what is D1? D1 is 11.5 divided by 75 plus 15% is equal to cost of equity. What is cost of equity? 30%. Right. You get 11.5 divided by 75 plus 15, you get cost of equity is 30. Using this cost of equity, you compute for based on revised growth. Using this cost of equity, compute based on revised growth. That KE is this much, D0 is this, growth rate is 18. So, you compute D1 by KE minus A, which is 11.8 divided by 30.33 minus 18, you get 95 rupees. What is current market price? 75 rupees. Now, what is the very specific question that is asked? You are required to determine the premium. Okay, what is the premium that can be paid? Okay, and over these two numbers, that is dividend growth or net worth. ICL will push forward using which method? Now, you see here in the first case, we got how much? 114 and 112. The premium is 53% and 49%. Whereas in this case, we got a value of 95, which is premium of 27%. What will they say? I will not want to pay such a hefty premium by giving a book net asset value plus the average profit of next 5 years. I will say I will give only 27% premium. So, as premium is lower in case of dividend discount model based valuation, ICL will push for second method during negotiation. You have to actually give the answer. If you don't give the answer, you will lose marks. Okay, and in this question, this is also a very important aspect. This is also a very important aspect, right? How do you find out KE and use that? Okay, you do not compute, the value of the share based on, 15%. 15% is current growth. So, based on that, current value is there. Using that, you find out the KE. Use it for future price of the share when the, merger happens and the growth rate increases. Okay. This one, we have finished question number 39. Then we have question number 46. This is a question from May 19. Given is the following information. Okay, day limited, night limited, net earnings. Net earnings means PAT, 5 crores and 3.5 crores. Equity shares is 10, what is this? 6 zeros, no? So 10 lakhs and 7 lakhs. So 5 crores by 10 lakhs, which is 50, right? 3.5 crores by 7 lakhs, which is also 50, which is what? What did I do? PAT by share count, which gives what? Which gives EPS. Okay. Shares of Day and Night Limited trade at 20 and 15 times their respective PE. So not PE ratios, you should say 20 and 15 times their earnings. Okay, PE ratio is 20 and 15. They don't trade at 20 times PE, they trade at 20 times their earnings. Okay, Day Limited considers taking over Night Limited by paying 55 crores consideration. Considering that the market price of Night reflects its true value, it is considering both the following options. Takeover is funded by cash, takeover is funded by stock. You are required to calculate the cost of takeover and advise Day Limited on the best alternative. What is cost of takeover? As far as the acquirer is concerned, cost of takeover is what is the value post-merger minus value pre-merger. That is what it is. Now, let us see what is it, entire by cash or stock. Now, how will we know what is cash, what is the cost of this? Okay, we'll see. As we move forward, we'll see. PAT is 5, 3.5, share count is 0.1, 0.0, so you get 50, both cases. PE is 20 and 15, so you get value as 1000 and 750. So far clear. Now what is market cap? Market cap is the price per share multiplied by number of shares. So here 1000 rupees multiplied by 10 lakhs, which is 100 crores, and 750 rupees multiplied by 7 lakhs, which is 52.5 crores. Okay, so total market cap on current basis is 152.5. Now, what did they say? Takeover is funded entirely by cash, and they want to say pay how much? 55 crores. If you are going to pay 55 crores when the company is worth only 52.5, you are paying extra. What is the cost of the merger? Cost of the merger is 2.5 crores. Okay, because that is what they said, right? Consider taking over, you are required to calculate cost of takeover and advise. Right. So if it is cash, you are paying 2.5 crores extra. If it is shares, what will happen if it is shares? See, how much you have to pay? You have already decided that this 55 is your consideration. Whether it is cash or it is shares, consideration is clear at 55. So 55 CR divided by your existing share price of 1000. Right, because that is what you are going to pay with. So you have to allot 5,50,000 shares. If you are going to allot 5,50,000 shares, what is the value of this particular entity? The value of this particular entity is originally 152.5 crores. Now, will this value change? Can you take that? So there are two scenarios. One is the old PE ratio will continue. Second thing is old PE ratio will not continue, but both market caps will combine. So there are two alternatives, right? First alternative what we'll take is assume that old market cap will continue. I typically don't agree with this in this kind of questions, but I'm just showing it because that's how ICA wants it. What is the share count? Old share count of acquirer is 10 lakhs. What issues to target is 5.5 lakhs. Total is 15.5 lakhs. So what is the value of the shares held by the target? 5.5 by 15.5, which is 35.48. So their share of market cap of 152 is 152 into 35.48, which is 54.11. So their share of the merger is 54.11, pre-merger is 52.5, and your purchase consideration you thought you will pay 55, right? So in this case, what will you do? Will you consider 54.11 and 52, because that is pre-merger market cap and post-merger market cap, or you have allotted shares worth 55 crores on what logic? On the logic of whatever is the share price and all of that stuff, but their share of market cap is only 54.1. So you can actually say, I wanted to allot 55, but I allotted only 54.11. So I actually allotted less. So the cost of this merger is actually negative. This is one way to look at it. This is one way, but I fully don't agree because when you are making an acquisition and when you are allotting shares, the PE ratio will change and combined earnings per new PE will be applicable. That is what I wanted to show here. Pre-merger equity PE is 20, post-merger share count is 15.5, post-merger PAT is 8.5. How did you get 8.5? We already have that figure here. 5 plus 3.5 is 8.5. So 8.5 into this 20 is post-merger market capitalization of 170 crores. Right. On this 170 crores, you have 35% stake. So 35% of 170 crores is 60 crores. Now, 60 crores is what they got. What is the pre-merger market cap of this fellow? Pre-merger market cap of this fellow is 52.5. You thought you were allotting shares of 55, but they got a value of 60. Right. So if you go by this logic, the gain that they have is what they got is 60.32 minus what you allotted 55. So the gain that they got is 5.32. This is the cost of merger. Okay, this is another way to look at it. Right. I fully don't agree with this logic, because when a company is acquiring another company, it is and they have not said anything about PE ratios changing, not changing. It is not just a simple summation of market caps. Okay. Given the cost of acquisition is negative in case takeover is funded by stock as compared to 2.5 cost when it is funded by cash, it is better to fund takeover by issuance of shares. So you have to actually write this. Why? Because they specifically ask what is your required cash requirement and suggest the best alternative and advise them on best alternative. What is the best alternative? If you go by this logic, you have a negative cost, which is 0.887, okay, which is when you pay by stock, whereas when you pay by cash, the cost is 2.5. You are paying 2.5. In other case, you are gaining 0.887. However, instead of 0.887, if you consider this as 5.32, then cash is better than stock. So you have to remember things like this, because they are slightly twisted. And please also note, in this particular question, we have not directly followed post minus pre market cap for finding out the value of the merger. We said post, okay, post minus what you thought was paid. Not pre. See, for cash we did pre, but for stock we did post merger market cap minus paid. So you can actually come back and write here also. Post merger market cap of target minus shares issued if available, minus value of shares issued if available. This is the point. Okay. I chose this question because I wanted to show this specific aspect. Okay. Now let us move to the next question. What is the next question? 4652. So let us look at now question number 52. This is an ICA practice manual question. Personal Computer Division of Distress Limited, a computer hardware manufacturing company, has started facing financial difficulties for the last 2 to 3 years. The management of the division, headed by Mr. Smith, is interested in a buyout on 1st April 13. However, to make this buyout successful, there is an urgent need to attract substantial funds from VCs. Vencap, a European VC, has shown interest to finance the proposed buyout. Distress Limited is interested to sell division at 180 crores, and Mr. Smith is of the opinion an additional discount of 80 crores, additional amount of 80 crores, not discount, shall be required to make this division viable. So I want to sell it at 180. You also believe that another 85 has to put. So as far as the investor is concerned, 180 is the cash outflow to buy out, and 85 is the repair, refurbishment, whatever you want to call it. Right. The expected financing pattern is as follows. Management, that is existing shareholders, will bring in 60. Right. And then the venture capital firm will give equity shares 22.5, debentures 22.5, and 8% loan at 160. So total is 265. Is this adding up? 180 here and 85 here, 265. It is adding up. Then 9% debentures with warrant attached of 100 each. Okay. And the warrants can be exercised anytime after 4 years from now for 10 equity shares at rupees 120 per share. There is a complication. Okay. The loan is repayable in one go at the end of 8th year. Okay. The debentures are repayable in equal. What loan? This is the 8% loan. Debentures are repayable in equal installment consisting of both principal and interest over a period of 6 years. So you have to find out the installment value. Then Mr. Smith is of the view that proposed dividend shall not be kept more than 12.5% of distributable profits for first 4 years. The forecasted EBIT after the proposed buyout is as follows: 48, 57, 68, 82. Applicable tax rate is 35%. Expected that it shall remain unchanged for at least 5-6 years. In order to attract Vencap, Smith stated that book value of equity shall increase by 20% during the above 4 years. Although Vencap has shown interest in investment, but are doubtful about the projections of the growth in value as per projections of Mr. Smith. Further, Vencap also demanded warrants should be convertible into 18 shares instead of 10 shares. Here they said 10 shares, 10 equity shares, they are saying 18 shares. You require to determine whether or not to book the book value of equity is expected to grow by 20% per year. Further, if you have been appointed by Smith as advisor, advise whether you would suggest to accept the demand of Vencap of 18 shares instead of 10. It's a very detailed, lengthy, complicated. I'm not sure if they will ask this kind of questions in exam. They may ask questions which have elements or parts of this. There is a warrant complication. There is a dilution because of the warrant. Then there is a loan. Then there is Then there is dividend projection. Then there is a 20% increase in book value. You have to look at so many aspects. Let us see. First, let us put out the data. What is the current EBIT? Current EBIT is not there, but future EBIT is given 48, 57. Let us take directly 48, 57, 68, 82. 57, 68, 82. Okay. Now, from this EBIT, you subtract what all? You subtract interest and tax. What is the interest? You have two kinds of loans. One is 9% debenture, one is 8% loan. And 9% debenture, they said, warrants can be excised, debentures are repayable in equal amount installment consisting of both principal and interest over a period of 6 years. So, you have to compute what is the interest element in the debenture. See, you have to find out the EMI. You have to find out the EMI. How will you find out the EMI? How will you find out the EMI? So, there is a working here, but we have to figure out how to find out the EMI. So, that is the bigger working. Loan amount is 22.5, loan is 9%, loan tenure is 6 years. So, EMI is just simply the loan value divided by the cumulative present value factor. See, what is the present value interest rate? 9%. 1.09, 1 by 1.09 is equal to 1, 2, 3, 4, 5, 6, and I do GT. I get 4.4859, you will take 4.46. So, 4.486 is the present value factor of a loan, cumulative present value factor at 9% discounting of 1 rupee, right. So, you divide your total loan by that, you will actually get the EMI, and EMI is how much? 5.015. So, 5.015 is the EMI, that is not the interest, that is only the EMI. So, you have to figure out what is the interest. How will you find out the interest? This 22.5 into 9% per year, 22.5 into 0.09. So, that will give you 2.025. So, out of this 5.015, 2.025 is the interest. So, you have opening loan, add interest, less in EMI, closing loan, how much is the principal paid, which is 2.0, whatever is the total EMI, from that you subtract the interest, you will get principal paid. Please do the full thing, don't forget in between. Okay, and we also need the EMI and we also need the interest. Why is interest needed? Because you need the P&L. So, 2.03, 1.76, 1.46, 1.14 and 0.79. So, you put those numbers here. These are the numbers. Have they said decimals? No, otherwise please put full numbers. Then interest on 160 crores. This 160 crores is what loan? It is a 8% loan, only repayable at the end. So, there is no EMI concept. So, directly into 160 into 8%, you get 12.8 crores. So, this is done. Then what? This is the PBT. You subtract from EBIT both the interest, you get PBT. Tax rate, have they given 35%? Tax rate is 35%, they have given, right. So, you subtract tax of 35% everywhere, you get the PAT. This PAT, you are also saying what? You also have a dividend complication. You will pay no more than 12.5. 12.5 of what? 12.5 of the face value, 12.5 of the book value, 12.5 of the profits. They said no more than 12.5% of distributable profits. So, next 4 years, out of these 21%, you pay 12.5. So, you subtract that, you get the retained earnings. Why is retained earnings required? You have to find out the book value. Okay. Now, management has put in 60 CR, venture capital has put 22.5, so total equity is 82.5. So, 82.5 plus the retained earnings every year. Okay, you get 82 plus 18 101, 101 plus 24 125, so on and so forth. You get the total book value of company. Right. Now, book value of the net worth of the book value of the company or net worth of the company, book value of equity or net worth. Now, 194 has increased from where? From 82.5. So, 194 by 82.5 power 4. You would simply do 194 by 82.5 is equal to, you do square root once, you do square root twice, you get 1.239 or something, right. So, 23.96%. What did we commit? He said book value will grow by 20%. Yes, book value is by growing more than 20%. So, this is over. You are required to mention whether or not book value. Yes, we have done that. Further, if you have appointed by Smith as advisor, whether you would suggest to accept the demand. Now, we are coming to the second aspect of it, which is whether you will accept the demand of 18 shares or you will go with that 15 shares. Now, you see what is happening. Current management share count is 6. Why is it 6? Because you have said here equity shares of 10 each, which is 60, because you are creating a new company by having of a division, right. So, 60 crores by 10 rupees is 6 crore shares. This is 6 crores. Then equity shares of 10, this is 2.25, right. Then debentures and loan, right. So, 2.25 and warrants, we will not put amount. So, how much shares do you have? 6 by 8.25 and 2.25 by 8.25. So, you have a ratio of 72 is to 27. Okay, VC ratio is 27. But if the conversion ratio is 10 shares or 18 shares. If it is 18 shares, if it is 10 shares or 18 shares. If it is 10 shares, for 2.25 whatever is the, if it is 10 shares, what is the loan that they have given? 22.5 crores worth of loan of 100 rupees each. So that is 0.225, 22.5 crores divided by 100, that is 22 lakh 500 share debentures. For each debenture you get 10 shares into 10, so you get 2.25 shares. Okay, so 2.25 crore shares are issued. So additional shares issued is 2.25 crores. So the VC will increase to 4.5. So what is VC's share? 4.5 out of 10.5, which is 42%. Whereas if you issue 18 shares, it becomes 32.93. How did it become 32.93? Because this became 4.05. How did it become 4.05? Whatever we multiplied, 0.225 into 10, instead of that you do into 18, you get 4.05. So you issue 4.05 crore shares, which will make their total shareholding as 32.93%. Right, we will suggest that Smith do not accept the demand for 18 shares, as it will reduce the management stake below 50%. So you have to make a statement. Why? Because they asked. Further, if you have been appointed, advise whether you would suggest him to accept the demand of Vencap demand of 18 shares instead of 10. I will say no to that particular demand. Okay, you have to necessarily answer this part. Okay, let us move to the next one. Now let us look at the next question. This is also from practice manual. A Limited wants to acquire T Limited and has offered a swap ratio of 1:2, that is 0.5 shares for every share of T. Following information is provided. PAT is 18 lakhs 3.6, outstanding shares is 6 lakhs and 1.8, EPS is 3 and 2, P ratio is 10 and 7, so market price is 30 and 14. They have only worked out certain things. Okay, required number of equity shares to be issued by A Limited for acquisition of T, based on what? This 1.5 ratio. It is very simple. They have how many equity shares? 1.8 lakh. So 1.8 lakh by half, which is 90,000. Simple. What is the EPS after the acquisition? So you add the share count, add the profits, divide by the new share count. That is also simple. Determine the equivalent earnings. This you have to determine. We will see how it is. What is the expected market price per share of A Limited after the acquisition? Assuming its PE multiple remains unchanged. This is what I was saying. So if this 10 PE continues, what is the market price of share? We will see, multiply by the revised EPS. Determine the market value. Market value is the revised price multiplied by revised share count. If you are a shareholder of T Limited holding 100 shares, would you be interested in selling your stake? Why? So we have to figure out whether a T shareholder will want to continue to hold his T shares, or will, because I am getting more value, which in what terms? In market price terms or EPS terms? They are not clear, we have to do both. Or will you sell out? If you sell out, what is your EPS, what is your market price? Right. Typically, as I kept on saying multiple times, it is market price, but ICA is very finicky about this. They want to do measure it on EPS terms also. Sometimes they have followed market price. So I would strongly suggest do both. First, very simple. No, first part is very simple. Number of shares is 1,80,000. You are issuing half the shares, so 90,000. That is over. Then what is EPS? EPS is post-merger PAT divided by post-merger share count. What is the post-merger PAT? 18 lakhs plus 3.6 lakhs, 21.6 lakhs. Divided by what is the revised share count? Original share count is 6 lakhs plus 90,000, so 6.9 lakhs. So 21.6 by 6.9, you get 3 rupees. What was the original EPS? Original EPS was 3. It has increased to 3.13. Correct? It has increased to 3.13. Then, what is the third question? Determine the equivalent earnings. What is equivalent earnings? Out of this 3.13, how much is attributable to you? Right, because for every one share, you got half a share. So half of this. What is the half of this? 1.57. I am getting 1.57 in EPS terms. Okay, earlier how much was I getting in EPS terms? I was getting it in 2 rupees. Will I be interested or not? Purely from an earnings perspective, my EPS has gone down. So I may not be interested. Okay, let us see. Then what? What is the expected market price of A after the acquisition, assuming multiple is unchanged? What is the multiple? 10 times. 10 into 3.13, which is 31.3. Super simple, no problem. Then determine the market value of the merged firm. What is market value of the merged firm? Total revised share count 6.9 lakhs into market price 31.3, whatever that comes out to. 6.9 lakhs into 31.3, which is 2 crores 15 lakh 97,000. Okay, that is also done. What is the next question? If you are a shareholder of T, would you be interested in selling your shares? See, from a market price of 14, what is now my value now? 31.3 into 0.5. Why? Equivalent value basis on market price. I have the market share price of acquirer is 31, but I got half a share for each of my shares. So I am getting 15.65, whereas my share is only 14. So from a market price perspective, it is fine. But from an EPS perspective, I am getting only 1.567 or 57, whereas my EPS earlier was 2. So from an EPS perspective, it is a dampener, it is bad, but from a market price perspective, it is very good. Let us see. As shareholder, one should exchange shares for value of 100 shares on a standalone basis, but post-merger share price of equivalent would be 50 shares, that is 1565. That is what I have said here, which is market price basis. That is on a share price basis, this 14 rupees 100 shares is 1400, which has increased to 15.65 into 100, 1565. Whereas from an EPS basis, I have lost. Okay, if possible, mention both the methods. Okay, fair enough. Now, let us move to this one problem they have added in the syllabus from one problem they have asked in the November 24 question paper. I wanted to specifically solve this. Okay. The company X Limited proposes to take over Y Limited. The chief executive of the company thinks that shareholders always look for EPS. He made a point, please note, EPS. Therefore, he considers maximization of EPS as his objective. The following information is available. Net profit 80 lakh, 15.75 lakh, PE ratio 10.5, 10, current market price 42.85. Okay. If current market price is there, PE is there, you can find out EPS. If EPS is there, net profit is there, you can find out the share count. Okay. Question 1 to 3. Right, maximum exchange ratio for which company should offer that could keep EPS at current level. So we have to find out what is EPS. What is EPS? We have current market price of 42 and PE ratio of 10.5. So 42 by 10.5. 42 by 10.5 will give you 4 and 85 by 10 will give you 8.5. So 4 is to 8.5. What is 4 is to 8.5? 8.5 divided by 2. Is 4.25. Is that what they mentioned? No, they mentioned in 8 point, what is 8.5 divided by 4? You get 2.125. So 1 is to 2.125. Is it there? Yes, 1 is to 2.125. Then company borrows funds at 15% rate of interest and buys out target company by paying cash. How much should he offer to keep his EPS at the assuming tax rate of 30%? What is EPS? Combined profit. What is combined profit? 80 lakhs plus 15.75 lakhs minus interest. What is interest? Interest is 15% of total buyout value, right, divided by share count. What is the share count? Existing share count. What is the existing share count? You have to find out. Who's buying whom? X is buying Y. So what is existing share count of X? You have 80 lakhs of profit and your EPS is what? EPS is 4. So your share count is 80 by 4, which is 20 lakhs. Okay. So this divided by 20 lakhs is your EPS will going to remain the same, right? Why? What is the EPS? That is what they said. If company borrows funds at 15% of interest and buys out target by paying cash, how much should offer to maintain its EPS assuming tax rate of 30? Oh, so this 15% of buyout into 30%, into 70%, I'm sorry. Because this buyout value, whatever you've paid off by borrowing, and on that borrowing you get an interest differential. So on that borrowing you make an interest payment. On that interest payment you get a tax benefit. So net of tax, what is the interest that you are paying? That is what will affect your PAT. So your old two PATs minus the net post-tax interest cost divided by the old share count should equal to your old EPS. That is the formula that you have to solve. Or you can say 80 lakhs is my old PAT, 80 by 20 plus 4 is equal to 80 by 20 plus 15.75 minus, what is your 15%, 70% of 15%? 10.5. 10.5% of B, whole thing by 20. Okay, and this already is 4. So this 4 is equal to 4 plus 0. So you basically say 15.75 minus 10.5% of buyout value by 20 is equal to 0. So you take the 0, 20 on the other side becomes 0. So 15.75 divided by 10.5% is equal to the buyout value, right? So which is 150 lakhs. 15.75 lakhs divided by 10.5% is equal to 150 lakhs. So what is the option here? Option is answer C. Okay, this is a slightly tricky one. You can solve it also, of course. Number of shares to be issued to X, issued by X. Now, in what ratio will you issue? See, this second question is about cash. So obviously, cash is not the desired one. But they said they look for earnings per share. The chief executive of the company thinks the shareholders always looks for earnings per share. So we consider maximization of EPS as his company's objectives. So will you issue shares in the ratio of EPS or will you issue shares in the ratio of market price? What is market price? 42 is to 85. What will you do? So that is the key question. So you will say assume based on ratio of EPS. Why? Because everybody will want the no gain, no loss is on EPS basis. So what you will do? you have EPS ratios. We can already computed 1 is to 2.125. So you will issue for every 1 share in Y Limited, you will issue 2.125 shares in X Limited. So how many shares are there in Y Limited? You have to compute the shares. How will you compute the shares? You have P ratio, you have net profit divided by, you do the EPS. What is the EPS? EPS we found out as 8.5. So 15.75 divided by 8.5 into 1 lakh is 1,85,294. So you have 1,85,294 shares in Y Limited. That you are issuing 2.125 shares for each of them. So you are issuing 393750, 3,93,750 shares. What is the existing share count of this fellow? Our existing guy is 20 lakhs. We found out somewhere. So 20 lakhs plus 3,97,000. What is the question they asked? Number of shares should be issued. The answer is 3,93,750. So 3.9375 lakhs. Okay, it took us some time. Okay, but we got the answer. In exam, if you get confused, gone. Exam, if you get confused, this part is gone because they've purposely given a twisted question, and I'm pretty sure going forward they'll ask more such twisted questions. Please be aware, please be careful. Okay, now this is done. Let us go and look at one question which I did not solve. This is on restructuring. Okay, this is I think the first question. So this is a question on restructuring. I said we will discuss it later. If you remember, I told you. One is banks, we discussed already. Restructuring. What do restructuring? Sources of benefit is equal to usage of benefits. Please remember this aspect. Compute cash balance, okay, and compute revised balance for balance sheet items. Please remember these 3 things. Now let us go back. This is a question from study material. The following is the balance sheet of XYZ Limited on 31st March 13. Liabilities and assets. 6 lakh equity shares of 100, which is 600 lakhs. Then 2 lakh, 14% preference shares of 200 lakhs, 13% debentures 200 lakhs, debenture interest accrued and payable is 26 lakhs, loan from bank is 74 lakhs, trade creditors 300, total 1400. Land building 200, plant and machinery 300, furniture fixtures 50, inventory 150, sundry debtors 70, cash is 130, preliminary expenses 10, cost of issue of debentures. What is this? This is miscellaneous expenses not written off, or expenses not written off. Then P&L, basically loss. 485. Okay, so this company is under some loss. The company did not perform well, obvious, okay, and has suffered sizable losses during the last few years. However, it is now felt that the company can be nursed back to health by proper financial restructuring. Consequently, the following scheme of reconstruction has been devised. What is the scheme? Equity shares are to be reduced to 25 per share, fully paid up. What is the current price? 100 rupees is the face value. You are making them 25. Preference shares are to be reduced with dividend rate of 10% to equal the number of rupees 50 each. Number of shares to equal number of shares of rupees 50 each, fully paid up. What is preference shares? 100. So you are saying preference shares to be reduced with dividend rate of 10%. What is original dividend rate? 14%. Okay, to equal number of shares. So basically same number of shares of 50 rupees. That also half. Debenture holders have agreed to forego interest accrued. Okay, how much is interest accrued? This 26. Okay, no problem. Beside this, they have agreed to accept new debentures carrying lower coupon of 9%. What is the original coupon? Original coupon was 13%. Okay. Then trade creditors have agreed to forego 25% of existing claim. What is the creditors? 300. 325% is 75. Okay. For balance sum, they have agreed to convert their claims into equity shares of 25. So that 225, which is 300 minus 75, that 225 also they will convert into equity shares of 25. In order to make payment for bank loan and augment the working capital, the company issues 6 lakh equity shares of 25 each. So fresh issue is also done. Entire sum is required to be paid on application. The existing shareholders have agreed to subscribe to issue. So existing shareholders will subscribe to the new issue also. While land building is to be revalued at 250. What was the original land building? 200. It is gone up to 250. Plant and machinery is to be written down to 104. What is plant and machinery? 300. From 300 to 104. Provision amount of 5 lakhs is to be made for bad and doubtful debt. So stock debtors will reduce from 70 to 65. You are required to show the impact of financial restructuring or reconstruction. Also prepare the new balance sheet assuming the scheme of reconstruction is implemented in the letter end spirit. So what is the first thing? You are required to prepare the balance sheet. That is the end task. But for balance sheet, you need balance sheet items. For balance sheet items, one of the items is cash. But before you come to cash, you have to say what are the changes in all the asset side and liability side. And on asset liability side, primarily there are a lot of changes because a lot of people have agreed to forego amounts and reduce capital and change the terms of debentures, so on and so forth. So what did I say? Benefits and usage of restructuring. What is benefit? Equity share capital reduction. How many shares are there? Originally 6 lakh shares of 100 rupees. How much are we reducing it to? We are reducing them to 25 rupees. So 600 into 75, right? 6 lakhs, not 600, 6 lakhs into 75, which makes it 450 lakhs. So 450 lakhs is one gain or benefits of reduction. Then preference shares. Preference shares, what is the value? You have 200 lakhs. Right, 200 lakhs is being reduced they're being reduced by half, I think. Preference shares of 50 at lower dividend. Dividend ignore, half. So this 200 will become 100. So 100 is the gain from preference shares. Then interest foregone by debenture holders, that is very clear, that 26 whatever it is. Trade creditors amount foregone, I said it's 75. So 25% of 300, 75, that also there. Increase in value of land building. This also is a benefit of restructuring. Okay, reduction in liabilities or increase in the value of an asset is benefit of restructuring. So 50. Total benefit is 701. In the balance sheet, this 701 is the change in balance sheet. This has to be compensated by a compensating 701 change in the balance sheet. So what are the other changes? You have reduced what all? Asset values. Land building you have increased, so nothing. Plant and machinery is reduced from 300 to 104, right? So 196 is the reduction. Then furniture, fixtures and all of that, they didn't say anything. They said provision of 5 is to be made, that is one reduction. Then these two also have to be adjusted, 485 and 5. Preliminary expenses is 3 items actually. Preliminary expenses, cost of debentures and P&L, 10, 5 and 485. 10, 5, 485 and provision of 5. All of them you put, you total up, you get the same 701. So the 701 of the benefits of restructuring and 701 of usage of restructuring. This is one statement you have to necessarily make. Okay, then you come to the balance sheet. In balance sheet, what are the changes? You have new capital issued. See, first of all, you have changes in capital, reduction of capital value. Then you also have new capital. So equity shares, this is the first number. What is equity share? Originally, you had 600, you made a reduction. So you have to draw the statement. If you don't draw the statement, you will not get marks. Right? So reduction of 450. How did we get 450? We wrote it down here only, 450. Okay, this 450 is reduction. Then fresh issue. Fresh issue is how much? You issued. How many shares our existing shareholders have agreed to subscribe? 6 lakh shares of 25 rupees each. 6 into 25 is 150. So you invest 150 and you issue to creditors shares. Why? Because the 300 of creditors, whatever was there, 75 is written off because they agreed to write it off, and 225 is converted into equity. So creditors will no longer be there. So 225 is equity. So total share capital is 525. Then same way, preference shares. You have 200, reduction of 100, 100. Then debentures. Debentures, they said this entire 200 of debentures will convert into same lower interest rate debentures of 9%. So you have to write that 9%. Okay, and here also preference shares 10% you have to write, and here you have to write 25 rupees face value. Okay, from FR if you recollect all of this. Then land and building we have increased to 250, plant and machinery is 104, your furniture fixtures 50, inventory is 150, receivables less of provision is 65, then cash. For this also you have to make a working note. What is cash? Originally you had opening balance of how much? 130. To this 130 you've received fresh equity share subscription of 150. So opening balance plus new share issued minus repayment of bank loan. Why? Because they have made a mention here. In order to make payment of bank loan and augment the working capital, they have used the word. So you repay the bank loan. That's why this bank loan is also not come here. 74 is not there. Why? Because bank loan has been repaid. So minus the bank loan. So 130 plus 150 minus 74 is 206. You put the 206 here, balance sheet to tally. You are all CFA students, simple balance sheet, you have to tally. Okay. So this is how you solve a restructuring question. Right. Now that we have gone through a bunch of questions, gone through, important practical tips, tricks, examination tips and all of that, how to solve these questions. Now we will go and look at some of the other theoretical concepts that I have not covered so far. Okay, this again will not take much time, we will finish it fairly quickly, but these are very interesting bits, and I believe these theory concepts are important because they may come in MCQs. So if you are watching this on YouTube or you are watching this in my paid revision classes, please remember these small tiny bit things can be asked as MCQ questions. Please be aware. What are these tiny bits? Let us see. So we have seen till here. Okay, we have discussed all these practical tips. Now let us look at these parts. Takeover defense tactics. So when there is a hostile takeover, the target has opportunity to defend itself. How will it defend? There are varieties of tactics. One is called divestiture. What is divestiture? You basically sell off the most important business. Divest or spin off a business, reducing the attractiveness. So the acquirer is acquiring the target for a very specific purpose of acquiring a division. If that division is sold off, the target becomes less attractive. Same way, crown jewel. Selling the most attractive part. They may be trying to acquire the one part of the business. You please sell off the most attractive part. That is called crown jewels. Poison pill. This poison pill means tablet. So poison pill means you take a poison tablet. That is dilute holdings by issuing convertible debentures in case of hostile takeover. If anybody tries to take over, I will issue huge number of convertible debentures on which there is a huge interest, and that interest the company will not be able to service. Or I will issue those convertible debentures which will convert at a very, very attractive rate. So the company may in its article of association put things like this. Poison put, just like poison pill, there is a poison put. That is issue bonds with redemption at a very, very high premium. Similar stuff. I will issue bonds very, very high premium. I will issue bond of 100 rupees, but it has to be redeemed at 200 rupees. Then green mail, just like blackmail, you have green mail. That is buy back own shares from hostile takeover bidder. You want to buy me because you've already acquired 5%. Please sell me back my 5%. I will buy it at a higher rate. Right. Then you have white knight. White knight means somebody who is coming to help you. Sell out to a friendly company instead of hostile bidder. Oh, you want to buy me, but I think you are a dangerous person. I will sell to my friend. I will ask them to bid the company. White square, very similar to white knight. Sell out to a company not interested in this business so that you can continue running the business. Golden parachute, this is also very interesting. That is, offer hefty payouts to key employees in case of hostile takeover. So all my major employees, I will pay each one of them $1 million. They all will go away. They are retired for life. Then what is the value of this company? Nothing. Then Pac-Man defense. Pac-Man defense is try and acquire the acquire in a hostile takeover. That is, you trying to acquire me, I will acquire you now. But for this, you need a lot of money, boss. Okay, all these are just tactics. Okay, for doing those also you require money. Then there is this concept called reverse merger. What is a reverse merger? A reverse merger is a smaller company gains control of a larger one. Okay, it is used for sick company revival. So, a sick company and let's say good well-to-do company, a sick company which is listed is not doing well, but there is a well-to-do company. So, that well-to-do company that is performing very well, in order to list itself, will do a reverse merger. That is, the sick company will acquire the listed sick company will acquire the unlisted good company. Okay, also known as backdoor listing. That's what I was saying. So, you can list it. Then test to be satisfied. But what are the tests to be satisfied for this reverse merger? Transfer of assets of transferor must be greater than transferee. So, transferor, the person should be greater than transferee. That is, I am being acquired, I should have more assets than transferee. Only then it's a reverse merger. Equity capital issued by transferee greater than original capital. So, my original capital was 10 lakhs. I am now issuing 20 lakhs, 30 lakhs, 40 lakhs shares. Right? That. Then change of control in the transferee company. Because I have issued 40 lakhs of capital share count versus original share count of 10 lakhs, the new shareholders will have 40 by 50, that is 40 by 40 plus 10. They will have 80% shareholding. That is why the equity capital issued should be greater than original capital, so that if it is greater, then minimum 51% stake the new people will have. Right? If I have 10 and I issue 10, okay, if I have 10 lakh shares and I issue another 10 lakh shares, the new shareholders will have 10 by 20, that is they will have 50%. So, if I have 10 lakh shares and issue 10 lakh 2 shares, then the new shareholders will have more than 50% shareholding. What are the benefits for the acquirer? The assets of the transfer company are greater than the transferee company. So, I am a bigger company which is getting listed, backdoor listing, my assets are more than acquirer. Equity capital to be issued by transferee company pursuant to the acquisition exceeds its original issued capital, that also I explained. And the change of control in transferee company through the introduction of minority group or a group of holders. So, the transferee company will lose the ownership of this particular their company. So, they become a minority shareholder. So, this is known as reverse merger. Then, what is financial restructuring? We just now discussed the problem on financial restructuring. What is the need? Inability to pay debts. If you are not able to pay your debts, stakeholders come together to protect and stabilize the entity. I just now explained. Meaning, refers to changes made by management assets and liabilities taking stakeholders' consent. So, you do this after taking all creditors, your lenders, bankers, everybody's consent. Suitable for entities with sizable loss over a period with negligible net worth. We just now saw sizable losses. They had huge P&L balance. Aimed at reducing debt or repayment burden on the firm. How did they reduce the debt? By issuing fresh debentures at a lower rate. They issued shares to your creditors, so things like that. Results in reduction or waiver in stakeholder claims. Obviously, the creditors reduce their claims, revaluing properties and using revaluing properties to write off losses. That's what we did in that particular question, right? So whatever we did in that question, we've seen here, right? Now, what is a demerger? Demerger, we saw reverse merger, now let's see demerger. Demerger involves a company selling one of its own divisions or and is used in following cases. That is, I will demerge myself. Why? Restructuring of a business. I am no longer interested in this business. I have a lot of business. One business is non-core, so I will sell it off. Division of family business. I have 3 kids. Each kid wants one division, so I will sell off. I will demerge each business and give it to them. Management buyout. So there is a management. My management is currently running one division. They want to buy out that division, so I will demerge it and sell it out. Reasons for divestment or demerger: to pay attention to core areas, which is what I was just telling you. Divest non-contributing business, bad business, sell it off. Business being too big to handle. There are big divisions, each division is huge division. Each division is huge. I am unable to handle, so I will make them separate companies with separate CEOs. Meet urgent cash requirement. I need urgently cash because some debt, where something is there, so I am selling off one division. These are the reasons why people do divestment or demerger. What is the reason why this, there is pressure on this to sell? That is, it increasing competitor pressure. That is, I am not able to face my competition, so I will sell off. And no access to new technologies. I am running old business without any new technology. Those guys are doing better, so there is no point continuing this business. I will sell it off. Strong barriers to market entry. Okay, then poor positioning supply and demand side. Very, very bad supply scenario. I will sell off. Inability to achieve critical mass. I am not able to scale. Inefficient utilization of distribution capabilities. I am not able to distribute properly. Inability to develop new strategic business units for future growth. The company is stagnant. Inadequate capital to complete the project. I started a project, I don't have money, so I will sell off. Window of opportunity, possibility to sell the business at attractive price. I am running a business, but that business now can be, I think its value is 100, somebody is willing to buy it at 200, so I will sell off. Focus on core competencies. Yes, you're focusing on core competencies. The best interest of shareholders, where a large, well-known firm brings up the proposal, the target company may be more than willing to give up. So if a large buyer wants to buy, if Tata's come in and say, I want to buy you, and they say, I'll give you 50 crores, 100 crores, I'll say, okay, right? Now, what are the forms of divestiture or demerger or divestment? You have a sell-off, you have a spin-off, you have a split-up, or you have an equity carve-out or a demerger of a division. Demerger we already saw. Let us briefly look at things. Sell-off is, it is of an asset, factory, division, product line or subsidiary by one entity to another because it is a non-core or combined business undervalued due to poor synergy, or you have to raise cash to pay off debts. These are the reasons why you sell off. What is spin-off? Spin-off is a part of the business separated as new entity. So sell-off is, I am selling, I don't want it. Spin-off is, I want it, but I am splitting it into 2 parts, and please see, the existing shareholders get proportionate ownership. The same shareholders who were holding shares in my company XYZ, now they get, out of that XYZ, I split the division called X. They have now shares in YZ also, they have shares in X also. And same ownership. There is no change in ownership, obviously, because same shareholders. Separate identity to a division. X division is new identity. Valuable division is spun off, is defense takeover. So, as defense takeover. So, valuable division, I am selling it off. So, if you are trying to divest one particular, if you are trying to acquire one particular business, I will divest the core business or I will spin off the core business and allot it to existing shareholders. Right. Then to separate regulated and unregulated business. This is also one thing where you try and separate unregulated and regulated businesses. Then you have something called a split up. That is breaking up an entire firm into series of spin-offs. So entire firm XYZ, X Limited, Y Limited, Z Limited. Parent no longer legally exists. XYZ no longer exists. Newly created entities survive, yes. Divisions become separate legal entities, yes. Then enhances shareholder value, brings efficiency and effectiveness, yes. Because each division is big, each division is managed by a separate CEO. Equity carve out. This is defined as a partial spin-off, create new subsidiary and IPO it. So you take a partial spin-off, that is, you basically create a subsidiary from your division and then IPO it and go out for an IPO. Control retained with the parent, because I am doing an IPO, probably I need to list only 25% of the shares. Generates cash, because I am selling my shares, I will get cash. Unlocks value, yes, there is an unlocking value, and enhanced parent's value. Because I hold now share in a company which is listed, the market price of the listed entity is more clearly available. So my value also increases. Demerger division of a family business, that is pressure to yield control to professional management. We just now discussed this. Or hive out division to meet succession problems, each child one division, or consolidating core businesses. So I will demerge unrelated business and consolidate core business. This is one. Then what are types of ownership restructuring? See, one of this is divestiture, disinvestment, divestment and demerger. This is types of restructuring. Leveraged buyout, equity buyout, management buyout, going private. What is leveraged buyout? If you remember, we discussed this in business valuation chapter also. Acquisition happens during borrowing. Target assets used as collateral. Target's assets are used as collateral. Target no longer remains public post LBO. That is, if there is a public limited company on whom a PE firm is doing a leveraged buyout, the PE firm will raise money by putting the public firm's assets as collateral. Using that money, they will buy out the shareholders who are public shareholders, and they will make the company private. Intent is to improve operational efficiency, sales and cash flow. Obviously, they'll improve the business. Post LBO, target is managed by private investors, the PE firm. Post turnaround and debt repayment, they may go public again. So once everything is played, the improvement in cash flows, cash generated, and operational efficiency is achieved, you may again do an IPO. Large acquisitions without having to commit a lot of capital. So you can do large acquisition without putting most of your money. You can do a leverage. What is equity buyout? Company buybacks its own shares. Okay, normal buyback. Results in capital reduction? Yes. Strengthens promoter position. Why? Because when your promoter shares are not bought, but your public shares are bought, public shareholding comes down, so promoter has more control. Company uses surplus cash to buy shares from public. That is what it is. What is management buyout? LBOs which are done by management at the help of a PE investor called management buyouts. Buyouts initiated by management team of a company. Company is bought by its own management team. It is used to exit non-core divisions. So you give off non-core divisions to the management, and they may do an LBO along with a PE to do it. What is going private? Listed companies converted into a private company. Public to private. Instead of private to public, public to private. Buy back all shares in the market, and happens when there are no benefits of being a public company. So a lot of companies do this when there is too much regulatory pressure. Initially, I thought that this is a good thing, but now there is way too much jamela boss. As public, I do audit committee rules, regulation. I am a small company, I don't need to do that. So let me become private. So a lot of people have done that also. Then, how to unlock value through M&A? Horizontal growth helps achieve optimum size, enlarge market share, curb competition, use unutilized capacity. So basically, what is horizontal growth? Horizontal means you are acquiring somebody in same line. Vertical combination helps to economize costs and eliminate avoidable taxes. Vertical means a buyer and supplier. You are combining a buyer and supplier, so it reduces costs. Diversification of business, obviously it helps diversify businesses. Use idle funds. If you have idle funds, you can use. Merger of an export, investment or trading house with an industrial company or vice versa with a view to increase cash flow. So a trading house may have more frequent cash flow, but export house may have infrequent cash flow but higher profits. Right. So when you merge both of them, then what happens is you basically are able to manage cash flows better. Merging subsidiary with holding company to improve cash flow, that also we discussed. Taking over a shell company with license, this also happens. There are a lot of shell companies which only have license. So you may buy such company, buy out the shareholders of that company and get the licenses. And nourishing a sick unit in the group and maintain group image. So you may also want to nourish a sick company in the group. Why? So that Tata Group, they don't want to be known as Tata Group's company defaulted. Right. So you may do an M&A and merge it with yourself. How to unlock value through restructuring? Competitive positioning, survive adverse economic condition, providing a new direction. So it helps you change the way you look at your own business. You survive tough situations by doing restructuring, and of course it provides you a new direction. Then, what is impact of share buyback? We discussed here share buyback, not here. I'm sorry. Where is this? Yeah, equity buyback. What is impact of share buyback? Because the share count decreases, obviously ROE and ROA, PAT remains the same. So ROE increase. Promoter holding increases, EPS and MPS increase because your PAT is remaining the same, share count has decreased. Reduction in cash and equity, obviously the cash will reduce, equity will reduce. For you financing cash outflow, so there is an outflow in terms of financing cash outflow in the cash flow statement. How are premium and discount in M&A deal arrived? This is also again important context. Timing is critical in M&A deal, so timing is everything. During bull phase there are more buyers but not sellers. Synergies non-realization is very high due to corporate market economic reasons or wrong estimation. So you should not overestimate synergy. If you underestimate, no problem, and the seller is at loss. But if you overestimate synergy, the buyer is at loss. Have a range of values for transaction different situations. This we discussed in business valuation also. Don't arrive at a value. Value arriving is last. Have a range of values, negotiate within that, use that to triangulate and arrive at a value. Use transaction multiple, comparable company, DCF, NAV, past earnings, use multiple approaches. We have seen that also in this. Okay. Then, why do M&As fail? Because acquirers overpay, synergy is overestimated, poor integration. This is a very, very important thing. There is a lot of culture clash, the psychological barrier. So you put pressure on the buyer, on the sellers, and sellers will leave. You put pressure on the seller's management team. You say, hey, we have acquired you, you are nobody. Seller management team leave. So you have post-merger integration is poor, or you have psychological barriers which cause a lot of M&As to fail. By the way, more than 90% of M&As in the world fail. Even then, there is a huge department called investment banking and M&A team in most of the investment banks. Okay. What are the steps in a successful program? We saw what are the reasons for failure. What are the steps in successful program? Manage pre-acquisition phase. So basically set objectives. What is it that you are going to do? How are you going to acquire? What is the process? Why are you acquiring all of that? Screen candidates, right? So you look at multiple candidates. Why you are acquiring? What are the potential list of candidates? Eliminate, disqualified. Whoever are not fit, eliminate. Value the rest. Arrive at a right value for the people who you like. Negotiate hard with them and then do the execution and do very, very good solid post-merger integration. This is very, very important. Secrecy during pre-acquisition phase to avoid price rise. This is very important. If you are acquiring a listed entity, if merger negotiations are on, information goes out, price will shoot up. Synergy depends on management. Synergy is not just an Excel figure. Only if management is able to extract the synergy, it exists. Otherwise, it doesn't exist. Integration of process and culture a must. I discussed that. Target managers must waste time on bureaucracy. A lot of times what happens is this target manager said, you are not aligning with our culture, you don't fit our ethics, you don't fit our mission, vision and all that. So a lot of time is wasted on all those aspects. So that should not happen. And motivated managers a must. So unless both parties sit together and figure out these are the managers who are going to drive the integration, it will not happen. Now, we already discussed this. How do you acquire through shares? You can acquire by cash or acquire through shares. How do you acquire through shares? Estimate the acquirer's value. That is, what is the value of the buyer, not the target. Then do the target. You need both. Why? Because of swap ratio, right? Determine the exchange ratio. Both companies' values have to be determined. Then analyze various scenarios. So you not only you have arrive at the exchange ratio, you can arrive at the exchange ratio on multiple bases, book value basis, fair market value basis, intrinsic value basis, a variety of things, right? Target shareholders will agree only if they benefit, correct, no, in terms of share price. But as I said, sometimes ICA looks at EPS also. The value of combined business is equal to combined earnings into combined PE ratio. This is the combined business value. This is how generally it happens in the market. So with this funny part, no, ICA gives all the right reasons in the theory, but in the practical questions, it uses all wrong logics, okay. A lower combined PE can offset the synergy gains, absolutely right. A higher PE ratio can lead to higher value of business even if there is no synergy. Yes, synergy means what are the future benefits in terms of increase in PAT. They may come from cost reduction, but more or less efficiency, effectiveness, new markets and all that. But valuation increase is achieved, it can be achieved by synergy or PE multiple. Both, okay. But even if there is no synergy, because of PE multiple re-rating, the valuation can increase. That is the point. Now, what are the factors influencing cross-border M&A? What is cross-border M&A? One company is India, one company is outside India. Okay, your Tata, Jaguar, Land Rover, things like that. Globalization of production and distribution of products and services. If you know, Jaguar, Land Rover, entire R&D is in UK. Okay. Integration of global economy. So steel is one place, your steel is secured from one place, the R&D is at one place, the management may be at different place. You are basically integrating global, at a global level, you are integrating a lot of stuff, logistics, marketing, design, everything. Expansion of trade and investment relationships on international level. Obviously, you will get to know better, connects, better, able to network better with key suppliers and all. Take advantage of investment and tax incentives for foreign investment. So some foreign countries, if you invest there, they give you tax incentives also. Privatization of state-owned enterprise and consolidation of banking industry. So this has happened. A lot of private entities were acquired and all that. This happened world over, and even in India it is acquired. But largely in India, we have seen Indian companies acquiring, Indian government entities. Then we have something called as SPAC. This is a very important question. I expect this kind of question to be asked in the exam. What is SPAC? SPAC is Special Purpose Acquisition Company. What does this company do? So, unlike a traditional case where an existing company raises money and does an IPO, you create a new company, do an IPO and then do an M&A. So, I am repeating, a new company is created by raising money from the public only for the purpose of acquiring some other company. Okay, very weird logic, right? SPAC raises money through IPO, okay. Money is used to merge with a company to be identified later. So, I will IPO first, then I will figure out whom to merge with. Shell firm structure is often called blank check company. So it's a shell firm, right? Because initially it doesn't have any business. It's called blank check company. Why? Because they've given them a blank check to go and acquire. IPO proceeds held in trust till acquisition is made. Very important. So IPO proceeds are not used for random expenses. They are held in a trust, in an escrow account. If acquisition not made within a period, money is returned net of cost. So I do an IPO of 100 crores, I put it in a trust, there is some income earned, there are some expenses incurred, let's say 95 crores is left, that if no acquisition is made in first 3 years or some as per the terms of the document, I will return the 95 crores. IPO shareholders have option to redeem shares if they don't like the target. This also is there. So if I subscribe to a SPAC and later the SPAC is acquiring some company and I don't like the company, I'll say I don't want these shares, I will please buy back my shares. SPAC target is announced only after agreements are signed. So only after agreements and everything is done, your SPAC target is announced. SPAC faces complex accounting and financial reporting registration requirements, obviously. In India, though, this is not even allowed. Only all this kind of weird stuff happens only in US. Should be ready to operate as a public company within 5 months from letter of intent. So even though you're going to acquire, instantaneously you cannot get everything set up. So you have to be ready to operate within after you merge the target with the SPAC, you should be ready to operate within 5 months. India does not support SPACs. IFSC Gandhinagar published a white paper exploring feasibility in India. But I don't see anything happening in India near term at least. Right. Then finally, what is the need or rationale for M&A? Why do people do M&A? Instantaneous growth, super fast growth, snuffing out competition. I will eliminate competition and increase market share. Very, very quickly I'll get market share. Then acquisition of a competence or capability. I don't have something, but I have money. So I will spend my money to acquire a company which has that capability. Entry into new markets or product segments. Tata, Jaguar Land Rover is a classic example. They acquired their company, it enabled them access not only to technology, R&D, new competence, it got them into US and European markets. It also got them into Indian markets for luxury vehicles. Access to funds. So there are some cases where, you may get access to funds. You may not have funds, you may issue a share swap based M&A deal may be executed and you may get access to funds of the target. Then tax benefits. Obviously, you have losses, they have profits, or they have profits, you have loss, and you do a merger, and then losses can be set off. Okay. Now, cross-border losses and all are very difficult, but within the country losses, yes, they can be set off. Right. So this concludes this particular chapter. It's a fairly important chapter. As I said, quite a few times questions have been asked. Very rarely has a question not been asked from this chapter, and I expect them to ask small, tiny little bits of questions which are in MCQ form where you may or may not know the meaning of it. Okay, because it is buried somewhere deep inside the study material, which is why I would strongly suggest you to go through this video. If you have understood it very well, if you have not understood, if you want to recollect or something, please go through this video again, whether you're watching on YouTube or you're watching on my revision classes. If you're watching on YouTube, please do like and share this video. Please do comment on this video. It will help us reach more people. And if you're watching on our website or app, then please continue to watch other revision classes also. Okay, other fast track revision classes what I've created, some of them are available on YouTube, some of them are not available on YouTube. Only paid course users for fast track revision get access to that. Okay, chalo, all the very best and do well.